collectively been speaking about how much electricity demand you need for AI and everything else. If you're going to pull manufacturing back, you also better have a great plan on what you're going to do with the energy infrastructure and the delivery of being able to say, sure, you can put a factory here, sure, you can put a data center here. Right now, you can't do that because you don't have the power to do it, literally. So I think that there are some ancillary issues that go around with some of those thought processes.
We're restarting nuclear plants to provide power to a tech company. Where is this heading?
You know, that's one of those things where you have to look at nuclear if you're going to say we need all these things that we want about how we're going to deal with the energy infrastructure. There was a renaissance, and then that terrible issue in Fukushima sort of cut that off. But I think that what that's telling you is the demand is there enough that people are willing to do things that would have been unthinkable 10 years ago. And I think that that's, you know, you look at what happened in Europe and how much of their nuclear capacity they've shut down, and you have to wonder, is that now something that they're rethinking? Because that's really creating problems.
So these were investment opportunities unthinkable a decade ago. Are you investing in this? And if so, how?
Well, so we like energy infrastructure, and one of the companies that I've mentioned before is Chart Industries. They make a lot of the equipment that goes into liquefied natural gas and other potential liquefying agents like hydrogen or other things like that. I think you have to look at that infrastructure. We went through a period where all of a sudden oil was nearly uninvestable and hydrocarbons were nearly uninvestable. And now people are coming back around to the fact that, wow, we really need a lot of power, and we need it from a lot of different sources, and we can't just rule out hydrocarbons that we like, the regular hydrocarbons. So you see a lot of areas where that investment is going to continue to take place, and that's something that we look at as well.
We're talking a lot about investment in the U.S. We're talking about the political sphere of the U.S. We're talking about U.S. stocks. How much do you have to stay in the United States at a time where all of these questions at least are, how much growth are we going to get? Not, are we going to enter some sort of severe recession? Or, in the case of China, can we pull ourselves out of a deflationary spiral?
Well, I think so. For us, we're very U.S. focused in our investments. So for us, we stay looking in the U.S., but the U.S. is a really important part of the global economy, right? So to get back to that idea of like, where do you go now? You're looking for companies that are in good cash shape, that are able to return cash to shareholders, either by buying back their stock or dividends. You know, we look at capital return very seriously, but the U.S. is really critical. If the U.S. is not doing well, the rest of the global economy is going to have a very difficult time doing well.
But is it U.S. exceptionalism on its own, or is it because it's being compared to places that are doing pretty poorly, especially in manufacturing, like Germany?
Well, I mean, all those terrible cliches about the worst dirty shirt and all that other stuff. I think that with the U.S., you really still have that innovation, and I think that that does drive, right? So the technological innovation that comes out of the U.S. really does drive. So however you want to characterize that, it does make a big difference, and it makes a huge difference in capital markets.
Sarah, it's good to see you. Always appreciate your time. Sarah Hunt there of Alpine Saxon Woods. We mentioned payrolls. Payrolls 2 Fridays away. The survey coming together, 7 estimates so far. The median estimate out of those 7, 140K is the estimate going into next Friday. 142, Lisa, the previous number.
To me, if it comes out like that, what do you do with it? I mean, that's basically the number that's going to leave nobody satisfied and determine nothing. So we get to do more of this.
The high estimate, 150. The low is about 100K. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Heckers. Hey, Yahara.
Hi, John. OpenAI has pitched the Biden administration on the need for massive data centers to power artificial intelligence development, as you were just talking about. The tech startup framed the proposal as necessary to compete with China, with each data center needing potentially as much power as what's needed for entire cities. Meanwhile, Kamala Harris and Donald Trump have no plans to debate again, but the candidates will participate in separate town halls hosted by Univision. The broadcaster said undecided Hispanic voters will ask the candidates questions, and the events will air with Spanish language translation. The Trump town hall will air on October 8th, while Harris will have her turn 2 days later on the 10th. And Sean Diddy Combs and Sam Bankman-Fried may be bunkmates. The Wall Street Journal is reporting the music mogul and the former crypto executive are being held at the same unit at the Metropolitan Detention Center in Brooklyn. Combs has been in jail since last week and was transferred to Bankman-Fried's unit on Monday. Combs is being held on sex trafficking charges, while Bankman-Fried is serving 25 years for fraud and conspiracy. That's your Bloomberg Brief. John.
Yahara, thank you. More from Yahara again in about 30 minutes' time. Up next on the program, economic policy taking shape.
Under my plan, American workers will no longer be worried about losing your jobs to foreign nations. Instead, foreign nations will be worried about losing their jobs to America.
Tobin Marcus of Wolf Research up next, live from New York. Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Coming into Wednesday, just off all-time highs on the S&P 500, negative by 0.02%. Under surveillance this morning, economic policy taking shape.
We're going to rebuild our manufacturing, and it's going to happen. It's going to happen fast and beautifully. And under my plan, American workers will no longer be worried about losing your jobs to foreign nations. Instead, foreign nations will be worried about losing their jobs to America. Your only worry will be deciding which job to take.
Making job openings great again. The former president of the United States and Kamala Harris promoting their economic plans across several swing state events. Trump heading to North Carolina, Harris making her case in Pittsburgh later today. Joining us now is Tobin Marcus of Wolf Research. Tobin, welcome back to the program. I've got a couple of questions. Ultimately, it starts like this. When you go through the polls, they seem to trust the former president with the economy more than the sitting vice president. The gap has narrowed, but he still has a slight edge. When you look at the national polling, Harris has a bigger lead over Trump, even though we know the economy seems to be the most important issue to the electorate right now. So it leads me to this question. Do you think the national polling is still underestimating the former president?
I wouldn't bank on the national polling underestimating Trump. There's always a possibility of a polling error. Our priors are that polling error is symmetrically distributed. You know, historically, polling error in one cycle hasn't predicted polling error in the next cycle. And I think the numbers make sense. I mean, the economy is the single most important issue. It's far from the only issue. In 2022, in the midterms, we saw, at a period when inflation really was out of control at the time, and I think it was even more stood over a lot of issues for swing voters is kind of the single most important thing. Republicans had an advantage and were not able to convert that into the red wave that a lot of people expected. So, it's a landscape when a lot of people have a lot of reasons for voting these two different candidates. They have very, very starkly different agendas that they've been articulating. So we're taking the polling, for the most part, at face value.
But in your note, you talk about the suspense of a potential Democratic trifecta, and you say that would present the most unexpected risks for markets. What would be the riskiest part of a blue sweep?
So, the reason why I think markets are probably, going to have a worse reaction to a blue sweep than the other scenarios that we're looking at in the immediate aftermath of the election is because, then you get the possibility of tax increases, in particular corporate rate hikes, that Harris has proposed. I mean, that's the key kind of consideration as we listen to these two candidates laying out their plans. Harris is very unlikely to have unified Democratic control to actually go ahead and do all the stuff that she's talking about. Trump is much more likely to have unified Republican control. And I think even more importantly, the things that he is talking about in more cases are things that he can do on his own, with tariffs being the big example. And to me, the big takeaway from his speech this week was just how much he is doubling, tripling, quadrupling down on tariffs. I don't know how anyone can listen to the agenda that he's laying out and the way he's laying it out and think that it's just kind of cheap talk about tariffs. I mean, it really plays a central role in the way he's thinking about his economic strategy.
Tobin, in your note, you also outline a number of potential risks or surprises that we can expect over the course of the next few weeks before November 5th. Which one of those is most likely?
I think the thing that we've been getting the most incoming questions about this week is the possibility of this port strike. Certainly, if we get sort of the worst version of that, where it's nationwide, it's protracted, it's totally unresolvable, that's something where you worry about, both the economic disruptions and what that would mean for the campaign. I think probably redounding to Trump's benefit. Our base case is that work stoppages are not as sweeping as I think feared, but that's an uncertain situation that we're taking day by day. So that's sort of the nearest one that we're watching.
Well, this would be in the East Coast. Which state could be most affected in terms of this impacting voters?
I think all the kind of coastal states you have some concern about. I think sort of manufacturing across the upper Midwest that kind of depends on port access, and then directly in Georgia and North Carolina. But really, I think it's less about kind of what it means for any particular voter in terms of the disruptions that they face, and more about the atmospherics of chaos, that sort of concerns about nationwide economic disruptions, the sense that sort of the labor movement is overreaching, that Biden and Harris aren't kind of strong enough to manage the situation. That, I think, would be the concern for them.
Tobin, I love that phrase, atmospherics of chaos, and I think that really is the name of this year. I am curious going forward, if you're looking at the potential for a House or a Congress that is for one party, a question of what one party can even do within itself. I mean, the Republicans cannot get together to come up with a provision to stave off the debt ceiling limit, and so you see Mike Johnson partnering with the Democrats. Is this basically what's going to happen regardless of who's at the top of the ticket?
So there's some things that will need to be done on a bipartisan basis, like keeping the government running, keeping the lights on. That's what they're struggling with this week. But I do think that if we get a Republican sweep, even though those margins are going to be very narrow, I think they're going to have to pass a big tax bill on a partisan basis next year to deal with this tax cliff. And so I think there will be a very, very, very strong incentive for Republicans in Congress to hold together on something. And the question is just what the contents of that package are. So, I'm not betting on Republican disarray to kind of completely stave off the threat of things like partial IRA rollback. I think investors have to take those risks seriously, even though we've seen obviously very fractious Republican contingent in Congress this year. With Trump in there, with very strong incentive for the team to kind of hold together and pass something, I do think we need to take that seriously.
We do get a speech later today from Kamala Harris. We've heard some of her proposals. Light on details. You say what you see is what you get, what you hear is what you get. What are you listening for today?
I think in terms of Harris, it really is more what the policies say about the candidate than what the candidate says about the policies. It really is not likely that she's going to have the chance to do the things that she's talking about. And so I think that the agenda she's laying out is mostly by way of letting voters know what she stands for. It'll be interesting to see what she says about industrial policy in particular. The previews of the speech indicate that she's going to talk about kind of targeted incentives, building on Biden's record in terms of the Inflation Reduction Act and the CHIPS Act of kind of trying to put targeted policies in place to bring strategic industries back to the states. So, I'll be watching what she's saying there with interest for the kind of medium-term future, how much both parties are kind of shifting towards industrial policy, but the likelihood that she can get any of that through in 2025 in the form that she's proposing it today, I think is quite low.
But Tobin, don't the policy speeches she gives now matter even more because of how many times she's flip-flopped in the course of the past few years?
Yeah, absolutely. And again, it's about giving voters a sense that they understand what she stands for, I think is the name of the game for her at this point. These are, she's trying to articulate a vision. She's trying to let swing voters have a sense of like, this is what she believes. These are the kinds of things she'll be trying to accomplish. These are the kinds of, people and industries that she's going to be fighting for. The actual content of a Harris presidency, will be a lot of bipartisan deals, will be a lot of case-by-case decisions about regulation. But, given how dramatically her stances have changed on a range of issues from 2019 to today, I do think that she needs to give people a sense that they can trust the agenda she's running on now, that this is the real Kamala Harris, and that the things that she's promising to do now at least represent her North Star, like her vision for the future, even if she's not going to have a chance to enact them in exactly the form she's laying out.
I guess we'll see. Tobin Marcus, thank you, of Wolf Research with the latest. I've got some data for you. Let's talk about it. Borrowing costs in the mortgage market, the lowest, the cheapest in 2 years. Check out this data. Applications to refinance mortgages absolutely surging for a second week. I'll share some of the data with you. The Mortgage Bankers Association's refinancing index jumping 20.3% in the week ending September 20th.
Well, yeah, if you borrowed money at 7.5%, wouldn't you refinance at 6.3% or something like that? I mean, you're going to see more and more of this. Really, the key issue for me is how much is this refinancing and how much is this new purchases? Because when you look at how long homes are sitting on listings, even though the number of homes is going up, they're sitting on listings for longer. So That's sort of the gap that people are looking to close.
People are excited to come back into the mortgage market, but when you say refinancing, I just think of my broker who continuously tells me, don't worry, apply, just refinance. You know the Fed's going to keep cutting.
The bulk of this is refinancing. To your point, what would it take to really unlock the inventory that's been locked up over the last few years?
Both the inventory and the true demand, and what would housing prices be? What's the clearing price? And that's something that I was reading actually a number of reports on yesterday, not for personal reasons, but I was just trying to understand. For just to understand. No, but in some places you're seeing housing prices tick down. Other places on average, they continue to climb, as we saw from data yesterday. But this is really the key question. When you start to unlock that, which direction do things go? Because the all-in costs are, I hear, still pretty expensive.
We'll talk about this more in about 20 minutes' time. Nothing personal here whatsoever. Danielle Hale, Chief Economist over at Realtor.com, joining us at about 7:45 Eastern Time. Up next on this program, we'll speak to Lisa Coleman of JP Morgan Asset Management on the headwinds to top-line revenue growth, the latest on the global credit market. Up next, equity futures just about unchanged from New York. You're watching Bloomberg TV.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Equity futures on the S&P 500 pulling back just a touch. We're down by 0.03% after closing at another record in yesterday's session. On the Nasdaq 100 down 0.2%. Nvidia lifting all boats seemingly in the world of tech yesterday.
So I was looking as to why, and it's because there is a sense that maybe Jensen Huang is done selling his shares.
The report in Barron's.
Okay, so that's the reason why Nvidia single-handedly lifted the stock market. I mean, it really raises this question of how divorced this market is from some sort of broader macroeconomic story. We're talking about the difference between 100 or 150,000 jobs. Is that going to really make the difference between a bull market and a bear market? And then it just comes down to whether Jensen Huang is selling his stock still.
The equity market's not the economy. We've said that repeatedly. That's been true for a while. Away from that, if you stripped out that story yesterday and looked at the move off the back of consumer confidence, there was some worry about the state of the labour market in that conference read. And I think that just gets people a bit anxious going into payrolls in 2 weeks' time.
A feeling of what are we missing? A feeling of are we on this sort of deterioration? And one thing that I thought was notable was Andrew Hollenhorst of Citigroup coming out and saying a variety of indicators confirm that the labour market is at risk of entering a period of more rapid weakening, and the idea that consumers feel like the number of job openings or job availability relative to a lack thereof is really going down. You're not seeing that kind of optimism going back to levels we saw just at the edge of the reemergence from the pandemic in 2021.
Andrew believes that by the time you get to November 7th, we'll be talking about another 50 basis point interest rate cut over at the Federal Reserve. Let's turn to the bond market. Yields lower yesterday off the back of that data. They're higher again this morning. The 10-year's up 3 basis points. Bramo, the 10-year, 376.02.
This is sort of the two sides of the fighting story. This idea that the Fed could cut by another 50 basis points in November. And at the same time, you see sustained growth to support risk assets. And that war is playing itself out in the bond market with the steepening of the yield curve. This idea that you could see ongoing growth. Question of which signal to take, right? Can the Fed continue to cut at that kind of pace without some more weakness that could threaten a longer-term trajectory for both risk assets and, frankly, for the economy?
Hardest trade in the world right now, one of them, I think euro dollar, 111.85, came really close to 112 overnight, 111.99, just short of reaching that level. I say it's really difficult because the data in Europe's bad. It's just really, really bad compared to still robust growth in the United States. And you see this from the OECD outlook again this morning, saying robust growth for the United States into 25, slower but better than what you're going to see out of places like Germany.
But maybe it has nothing to do with Germany. Maybe it has nothing to do with Europe. Maybe it just entirely has to do with the People's Bank of Japan and how much they're going to cut rates overnight. And that's the reason why you are correct. If you're trading euro dollar this morning, I really feel for you, because how do you get a handle on which narrative to follow? Is it the delta between the U.S. and Europe in growth or rates? Is it also just what's going on with respect to how much stimulus the PBOC can inject?
Speaking of China and the stimulus they've been injecting, dollar CNH, the offshore yuan, breaking 7 for the first time in about 16 months, a little bit earlier in the session, just north of that level at the moment. That currency pair now firmer by 0.2%. Let's get you some news. Under surveillance this morning, the Iranian president saying plans are underway to discuss a nuclear deal that's been stalled for years, but didn't provide details on the timing and location of discussions. The Iranian leader telling Bloomberg the deal was among topics raised with French President Emmanuel Macron on the sidelines of the UN General Assembly.
So I guess Masoud Pezeshkian, the new Iranian president, is feeling pretty positive, he said, coming out of this meeting. But I'm sorry, what Iran says and what Iran does is completely different. What are they doing? They're supporting a terrorist regime as what the United States designates when it comes to Hamas, when it comes to Hezbollah. We have overnight the Trump campaign coming out and talking about a, quote, significant threat the Biden administration has told Trump on his life based off the Iranians. But then you have the Iranian leader come to the United Nations in New York City and say, nuclear talks, anyone?
Honestly, this is to me the issue when you have a situation where Iran is speaking out of both sides of their mouths, right? They're talking about potentially accelerating some of their involvement in the conflicts that are ongoing, saying that Israel can't get away with this. And on the flip side, you have sort of a make peace kind of feeling. This, to me, is why traffic is so bad in the United States right now in New York City.
Good
because
Let's go.
You have Iran, you've got the president of Iran.
It's Macron's fault too.
Yes,
There's always
he's
Macron
here.
playing statesman
Macron's
somewhere,
here.
right? Always,
You've got Joe Biden. You've got maybe
dining
Trump
on the Upper East Side.
I'm
you
really
have
on board with this.
You have, hold on a second. You have the Prime Minister of Israel that's going to join this fray on Thursday, supposedly.
His fault too.
Well, You have the Turkish president, you have pretty much everybody under the sun who all hate each other coming here and getting in a room, and so traffic is basically completely stalled.
Someone got stuck in traffic yesterday. It's basically the conclusion of that rant, right? That felt very personal.
I mean, can you imagine, all sort of consolidated in less than a square mile?
It's always Macron's fault somewhere, right?
You can blame him.
Plain statesman. Volkswagen and its unions starting negotiations over wide-ranging cost cuts. The talks centering on the automaker's plan to potentially close German factories for the first time after scrapping decades-old job protections earlier this month. This one's going to be a battle, a real fight over in Germany.
Oh, absolutely. And this is going to become very, very political because you cannot lose jobs in the German manufacturing base. This was the darling of Europe when it comes to the auto manufacturing in Europe. The union's already talking about there will be no cuts. How does VW and all these other companies start potentially turn a profit? And guess where they're laying the blame? At the politicians, because the destination and the goal of getting there do not match.
VW right now down 0.5%. I want to turn to this story, just an update. Univision announcing 2 separate town halls next month with Donald Trump and Kamala Harris, both in front of a Spanish-speaking audience. The candidates getting the opportunity to speak to one of the largest voting blocs in this country.
36 million Hispanics. That is the voting bloc of those individuals in the United States. This is an opportunity, a town hall. I really want to see if we get details of these policy ideas. They're all talking about spaghetti at the wall, the Oprah Winfrey election. What are the details and actually how you would accomplish these things?
I find it interesting. The Hispanic vote in this country used to go for the Democrats, and it's changing. And I find that kind of really interesting. I also find it interesting we're talking about town halls, not debates. We're not talking about personal interviews.
36% went for Trump in 2020. So, this is a vote that you cannot ignore.
Minority groups in this country haven't been happy about the liberal immigration policies either. I think you've seen examples of that repeatedly.
And you do see that, especially in the Hispanic community. Many of them will say, and I've spoken to some of these individuals, I came here legally. It took me a ton of money, legal fees, a ton of time. It was a huge burden on my family. And actually, they are very annoyed with the levels of illegal immigration into this country.
One to watch in the next month or so. Let's talk about this market. U.S. companies looking to protect the top and bottom line as the Fed kicks off its easing cycle. Lisa Coleman of J.P. Morgan Asset Management writing, companies have been working hard to maintain margins by maximizing efficiencies wherever possible, except for tech. Layoffs have not been and are not anticipated near term. Lisa joins us for more. Lisa, good morning. It's good to see you, as always.
Nice to see you, too.
Before we talk about margins, let's talk about top-line revenue growth. Why do you think that's going to be so challenged in the year to come?
Yeah, it's been declining steadily. When we look back over the trough in EBITDA, so, going back, let's say, about a year, that started to recover, and it's really moving very nicely up. But revenue at the top line has just been slowing and slowing. I think that's consistent with a slower economy. But I think what's really fascinating about this is companies, I give this analogy, companies are like a duck on the lake, right? They see this top line that's kind of waning a bit, and they're really trying to maintain margins, and they're paddling faster and faster and faster, and they're doing a really good job of maintaining margins. When you look at the median company within our investment grade universe, they've been able to maintain margins at around 14% on an operating margin basis. That's pretty good. So, really what we're waiting for now is, can we start to see a kickstart to the top line? And I think this probably goes back to what the Fed's going to do with the economy.
So what I'd be worried about, and this is me, I'm a worrier, I've got Lisa for company. What I'd be worried about is that the next step is that they run out of their ability to maximize efficiencies and protect margins, and the next step is layoffs. Do you think we're easing early enough to say really the next step's top line revenue growth and margins are going to be okay?
Right. Well, it's interesting you make this point, because when we went through, we looked sector by sector. And as you mentioned in your lead-in, it's really just tech that has been the one area that's been laying off. Now, tech has been using layoffs as a way to maintain margins for probably the better part of 2 years. So this is not a new phenomenon with tech. But you're right, other sectors really have not. And, we can look at, how they've maintained margins. So you look at energy companies, there's technological change. Companies have been very good about making acquisitions where they had more contiguous acreage. So there's no need to make layoffs there. Even the spot of consumer goods, for example, companies built in a lot of resiliency in light of the supply chain problems that we had earlier. But maybe they don't need that anymore. So, we've had the efficiencies come through. But I think you're right. If we don't start to see an improvement in the top line, can employment start to be the lever that they pull? So far, I think there's been a reluctance, and maybe it's a little PTSD after what happened during COVID with finding people, training people, and the like. But I think it's something that we're a little bit on a precipice here.
I love the granularity that you have when you look under the hood. And I want to go a little further and talk about the nature of how these companies look at employment, because it speaks to the uncertainty that we see in the data. How much are companies not making broad-based layoffs, but not hiring either, and kind of relying on attrition and expecting to end up with a smaller footprint relative to the size of their businesses? And I'm thinking of U.S. banks, where CEOs have even come out and said that that's going to be the future. I mean, is that kind of what you're seeing in terms of this paddling duck type of corporate sphere that we're looking at?
So far, not yet. I think if I were to get down to that level of granularity, I think we'd see that there is not necessarily new hiring. And so you know how the drill goes. You take away the job openings that might be posted. Maybe you pull that back there, so you're not actually removing workers from your company. But I don't know. I think as we maybe go further down the road, if we don't see the economy start to pick up, as John was saying earlier, I think we are going to see maybe some deeper layoffs. But again, nothing to indicate that at this point. Everything, it's like the calm waters on the top, the duck just paddling along.
So moving from 1,000 feet to 5,000 feet, there's a question about the U.S. We're talking about companies here and their ability to withstand and maintain that 14% margin. How different are things right now in Europe, in particular in Germany, in the sphere that you're looking at?
Yeah, very, very different. So we did a little comparison across Europe. We looked across sectors and said, who's doing well in Europe and who's not doing well? And what we found is companies with exposure to China were doing much worse than those companies that didn't have that exposure. So just to throw a few numbers on it, if you look at EBITDA growth through the end of the year that we're projecting, for Europe in general, we're thinking around 3%. If you're looking at companies with exposure to China, we're seeing those companies down 5%. So it is a vast difference. Now, granted, some of that is influenced by auto manufacturers. And auto is not just about China. There are other issues. But yet, you see it in companies with retail exposure, with consumer products. They're all starting to see or feeling that downturn and that lack of growth that's coming through in China. And I think that is the big difference between U.S. companies and many companies in Europe, is that China representation.
Lisa, do you think that's an opportunity, given the easing we've started to see from Chinese authorities in the past 24 hours?
Yeah, I think it's too early to know. I really do. We're just at the very early stages. I mean, autos are a different one, a different kettle of fish here, because the China story is much more complex for autos. What a lot of people may not realize is when you start to look through the surface at auto manufacturers, particularly European ones, where they're making their most money in China is not on EVs, but on ICE vehicles. And ICE vehicles are considered to be premium vehicles in China. Now, if you start to get tariffs put on Chinese EVs by the European authorities, do you get retaliation on ICE vehicles in China? So there you have, a little bit of a nuanced situation. And of course, as you alluded to earlier, for some of the auto manufacturers, there are very aggressive targets for emissions coming through, and that's really forced a lot of these companies into making very large capital investments, particularly at a time now we're seeing with EV demand starting to wane.
How investable are auto credit right now in Europe?
I think, so look, I think when we talk to the ratings agencies, what we're told is they will have some time. There is not an imminent downgrade expected for these companies. And when you look back, think about during the COVID period, these companies made a lot of money. And so they have really a little bit of money in the bank, let's put it that way. When we look at leverage, it's very low. Margins are still pretty good, but they're coming down. So again, the health is not bad. The ratings agencies don't appear to be primed, at least at this point, for downgrades, but I think you're subject to headline risk. And that is likely to continue for the next month, 2 months. But I think at that point, you may have an opportunity once we see spreads really compensate you for some of that headline volatility to get back into the space.
When you think of volatility, you have to think of the U.S. election. How much do you see these companies basically waiting on the sidelines so they have a little bit more clarity?
Yeah, I wouldn't blame them for waiting on the headlines. I mean, yesterday there was a good headline on Deere that we're all aware of. And I think what this speaks to is really, I think companies want certainty, particularly if you're looking at making large capital investments. And so until the elections have been decided, and also the composition of Congress is decided, I would suspect that many companies would probably take a wait-and-see approach.
The auto sector is in such a tight spot right now. The remedies that are required in Europe to cut capacity, to cut jobs, there's going to be massive opposition to them from unions and from government officials, particularly in Germany. And to Lisa's point, the outlook for tariffs, you've got no idea what the next 12, 18 months is going to look like for some of these companies.
Yeah, I love her point about the difference in the cars that get purchased in China. I was speaking to a car manufacturer from Germany, and they said that they're designed differently in China because normally it's the driver's seat that's really nice and that has enough space, and that the cars that they sell to China, it's actually the passenger seat because there's always a driver.
Live to be driven.
Yes.
Not to drive.
Is that your goal?
Basically. That's what Rolls Royces are for, right?
I guess so. I wouldn't know.
To be driven in, not to
Robo
drive.
taxis.
Lisa, thank you. It's good to see you.
Thank you very
Appreciate
much.
it. Lisa Coleman there of JP Morgan Asset Management. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg brief with Yahara Hackers. Hey, Yahara.
Hi, John. Japanese banking giant Nomura is facing a fine of over $150,000 for allegedly manipulating Japan's bond futures market. A Nomura employee is suspected of fraudulently moving government bond futures back in 2021, placing large orders without intending to buy or sell them. The relatively small fine is seen as a threat to the investment bank's reputation at a time where it's refocusing on Japan as a key growth area for its business. Meanwhile, UK Prime Minister Keir Starmer wants to meet Vice President Kamala Harris and former President Donald Trump before the election. The Prime Minister has said Britain will work with whoever wins, but his governing Labour Party has connections to Democrats. Starmer is in New York for the UN General Assembly this week. And in sports, the Houston Astros clinched their fourth straight American League West title in a come-from-behind win, while the Baltimore Orioles secured their second straight playoff spot, and the Kansas City Royals held on to the second AL wildcard spot. That coming as the Mets and Braves battle for a spot in the National League wildcard, with Atlanta taking Game 1 of the pivotal series that could face weather delays with Tropical Storm Helene expected to hit northern Georgia today. That's your Bloomberg Brief. John?
Yahara, thank you. Are we all Baltimore fans now?
No.
Is that like company policy?
Absolutely not.
To get behind the Orioles?
If it is, I haven't gotten that cue, and this family is squarely in the Mets
They
position.
won last night, so congratulations, David Rubenstein, if you're watching. But Aaron Judge, 56th home run last night. It was incredible.
There we go. We can see who supports who here. Up next on the program, the Fed's hand in housing.
I think the Fed's going to pay attention to inflation, but probably what they're looking at more than any campaign promises is really what's happening with real estate, because that's the sort of the last piece of taming inflation.
Danielle Hale of Realtor.com. Up next on the program from New York. This is Bloomberg.
The top names in business are on Bloomberg.
The challenge for us now is not very much on the product, it's on the ramp-up of the production system.
We turned the industry down to almost zero during the pandemic. And what we're trying to do now is turn it all the way back on. And that's hard. We lost not only people during the pandemic, we lost a tremendous amount of experience.
A lot of skilled people have left the industry. We have to hire new people. The supply chain has to hire new resources and train the people, educate them.
And because those roles are filled now not by a 58-year-old, but perhaps by a 28-year-old, there's a lot we have to do in terms of not only adding capacity, but capability to meet the ramp that we all are embarked upon.
We have thousands of suppliers, and when you have just a couple of them, few of them that are late on the ramp-up, well, that's slowing down everybody, and that's what we've been facing earlier this year.
Nobody covers business like Bloomberg. Context changes everything. From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
We're down 0.1% on the S&P 500, just a little bit softer this Wednesday morning, up 3 basis points on a 10-year, your yield 376. Under surveillance this morning, the Fed's hand in housing.
I think the Fed's going to pay attention to inflation, but probably what they're looking at more than any campaign promises is really what's happening with real estate, because that's the sort of the last piece of taming inflation. And the problem in real estate is that you've had not enough housing for over a decade.
So here's the latest this morning. Applications to refinance home loans surging for a second week. According to the Mortgage Bankers Association, homeowners are looking to take advantage of lower rates. A 30-year fixed mortgage sitting at just over 6.1%. Danielle Hale of Realtor.com saying this: surveys show that consumers expect additional mortgage rate declines in the next year, now that the Fed's long-awaited cut has arrived. However, the improvements may be more modest than we've seen to date. Danielle joins us for more. Danielle, welcome to the program. So we've seen refis explode, surge over the last few weeks. How low do you think that rate needs to go before we start to see home purchases actually start to accelerate in a more material way?
Yeah, thanks for having me. So we've started to see a bit of a week-to-week uptick in the purchase applications, but it takes time for buyers to become aware. And remember, the mortgage application is a later stage in the home buying process. You have to have an offer on a home that has been accepted before you go to apply for a mortgage. So what we will actually likely see is that pending home sales start to pick up, and then mortgage applications follow. The pending date is a monthly series. The mortgage applications are obviously weekly, so timing-wise, we might see the result in the mortgage applications first. But there's an order of operations here. So offer is accepted, and the buyer applies for a mortgage, and that's when we see it reflected in this MBA data.
Danielle, what do you make of the fact that actual listings have increased? It seems like there is some motion in the pool of existing homes that are actually finally up for sale.
Yeah, we've seen the number of homes on the market for sale growing very slowly over the year, but we're now up about 36% compared to last year. So it is a substantial improvement. Big picture context, we're still down pretty substantially from the 2017 to 2019 period, which suggests to me that there's more room for recovery in the market. And, you know, as we see more sellers come into the market, we'll see that room improve. And I think it's important to note that existing home sellers are often also buying another home. So when we see existing home listings increase, we're really increasing both supply and demand in the housing market, which will help increase the turnover rate in home sales that has been rather sluggish in recent months.
I've seen a number of reports, Danielle, that show that homes haven't moved as quickly as some people had expected. So even though there are more listings, it's not as though they're flying off the shelves, and understanding that mortgage rates are still relatively high to where they used to be. How much do you view this as a sign of what's to come, that essentially, as you defreeze this market, you won't necessarily see the same kind of price increases as some people are calling for on the heels of lower mortgage rates?
Yeah, I think with affordability as stretched as it is in the housing market, there's less room for prices to run. That said, everyone, I think, has been surprised at how resilient prices have been in the face of higher mortgage rates. So buyers have been willing to stretch affordability as opposed to necessarily waiting for home prices to fall. And the big picture inventory shortage that we see is a big explanation for that. So if we look over the last decade, we are several million homes short of the number of households that have been added. And when you have that kind of scarcity in the market, it's hard to see prices really relax or decline in any meaningful sort of way. So I do think as mortgage rates improve, we are going to see buyers come back to the market. If we look at the time it takes to sell a home, we are seeing homes take longer to sell than 1 year ago. But again, if you compare to that pre-pandemic benchmark, we're still seeing homes sell about a week faster. And so I think we have some more room for the time on market to slow. At the same time, technology has improved, and it's much easier for, I think, shoppers to find a match in a home now than it was 4 or 5 years ago before the pandemic. And so we may see some of those, that market speed kind of stay as a factor in the housing market. And so buyers may have to make quicker decisions. But I think there are two things going on. There's the market momentum, and then there's the seasonal momentum that we see. And fall tends to be a slower period for the housing market. We see buyer demand wane. It's one of the reasons that we identify next week actually as the best time to buy, because buyers have some seasonal advantages with fewer of them and a good number of sellers still in the market. They have more negotiating power and often tend to see lower home prices than we do at the peak of the summer. So for buyers who are flexible and are not trying to sell a home as well, it can be a really good opportunity to get into the housing market. And the fact that rates are coming down now is just an added bonus.
We've got a flexible buyer sitting around the table, so we appreciate that particular advice. Danielle, thank you. Danielle Howe there of Realtor.com. Look for rates to go a whole lot lower from here.
Well, if we only just had Lisa's 3%, wouldn't we all be, knocking on the door?
Be retired.
Are you trying to push me out? Okay.
No, I'd be retired.
This is an announcement.
I'd come in. I told you I promised you 60 minutes a day.
60 minutes?
60 minutes.
And then you go tend to
I'd
the
come in for
the goats?
I think I'd come in for the 8 o'clock hour. Then I'd tend to the goats.
Okay,
Why am I tending to goats? What am I doing?
No, you have...
A goat farmer?
You have lemon groves and you have cows for your ice cream.
Okay, that sounds perfect. I'm not sure where the goats come in. Up next on the programme, Marianne Bartels of Sanctuary Wealth, Scott Ciccarelli of Truist, Lara Rame of FS Investments, and Victoria Fernandez of Crossmark. The third hour of Bloomberg Surveillance is up next.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take 2 numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Why should I want to invest in the pharmaceutical industry? Is it going to continue to grow as it did last year? And what about your own company? Do you think it's going to have good growth prospects over the next couple of years?
I think the reason to invest in the sector is the science. I mean, when you look again, if I go back into the history, for most of the last century, we were only giving people pills and small molecule drugs. Then we discovered that we had this whole world of biologics, and we could treat diseases with biologicals. More recently, we've discovered that we can reprogram your cells, we can edit the genome, We can use these RNA therapeutics to completely transform areas of medicine. Those technology areas are at their very nascent stage. And what we're going to find is they're going to open up whole new areas of growth from our business standpoint and a human health impact standpoint. We hope that as we work in our areas like cell therapy and RNA therapeutics, we will also be able to climb to a whole other level of market cap over time.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
There is a lot to like. I mean, this basically all comes down to the resiliency of the economy.
We expect the U.S. economy to continue to expand, to continue to grow with solid momentum.
Eventually, we do think that an economic contraction plays out.
Overall, the economy is performing like it doesn't really get impacted by kind of these swings in rates.
I think the bond market rally and the equity market need to happen in tandem, and they need to make sense rationally for what's going on in the economy.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Snoozy morning so far this morning, and we'll take that 90 minutes out from the opening bout. Equity futures just about unchanged on the S&P 500, down about 0.1% on the Nasdaq 100. Some relative outperformance on the Russell there, up 0.1%. Some muted price action, Lisa, in the last few hours.
Yeah, maybe it's because everyone's at home, because nobody wants to go through the traffic in Midtown Manhattan for the UNGA week. Is that what people call it? UNGA? Look, this to me, why would anyone make a major trade ahead of earnings? And actually, we haven't even talked about earnings, but I think earnings could potentially be one of the biggest catalysts going forward, as well as, of course, that non-farm payrolls, which evidently the difference between 100,000 and 150,000 is going to mean the difference between a bear market and a bull market.
And what we've been hearing, at least from the consumers on the survey board, I keep going back to this metric. Those that say the jobs are plentiful, declining. Those that say, actually, it's hard to get a job, that's rising. This is challenging, but it's leaning into this idea of traders who think potentially we're going to have to go 50. And then you hear from the Fed Governor Bowman yesterday saying that she actually wants to see a moderated path. Very different than, say, Goolsbee, who's talking about we're going to need some significant cuts.
Just to pick up on what you said, that differential in consumer confidence about plentiful jobs and jobs hard to get, when that starts to narrow, economists get concerned. That's been narrowing now for a number of months. That speaks to some weakness or some weakening in this labor market.
It was the weakest read going back to March of 2021. But the reason why I asked such a narrow question to Lisa Coleman last hour, I'm justifying narrow questions on a snoozy morning, but let me just explain that to me, there is this sort of feeling there have been structural changes in the labor market, the way that companies view labor post-pandemic, that mean that there's just more stasis. There isn't as much hiring, but there also isn't as much firing. Is that a healthy, good labor market? And that, I think, is going to be something a lot of economists are going to be thinking about.
You can only push it so far. So to pick up on Lisa Coleman's point, she joined us in about the last hour or so, about 20 minutes ago, and made the point that top-line growth is threatened. For obvious reasons, inflation's come down, GDP is decelerated, nominal GDP is lower. Got all that. When that happens, you start to protect margins. What do you do? Maximize efficiencies. The last thing you want to do is start layoffs, given that they were so difficult to hire after the pandemic. So now what you're hoping for is a re-acceleration in growth off the back of interest rate cuts so that we don't go through this layoff cycle. And that's really the difference between being bullish and bearish right now. What you think or don't think is going to happen to the labor market in the next 12 months.
Which is the reason why some of these incremental data points are going to be so important and potential catalysts for some volatility. If we get 140,000, which is the median, that settles nothing, because ultimately you'll have people arguing both sides of the discussion, as we have been for the past 6 months.
Got jobless claims before we get payrolls. Payrolls 2 Fridays away. Jobless claims tomorrow morning at 8:30 Eastern time. The estimate in our survey, 224. The previous week, 219. The price action looks like this. Equities pulling back by not even 0.1% on the S&P 500. The move in yields, we resume the climb. We're up by 3 or 4 basis points on a 10-year, Lisa, 376.40.
What's fascinating is the steady grind higher in 10-year yields since the 50 basis point move by the Federal Reserve. Early days, Hard to make so much about this, but we've talked about reigniting of inflation concerns. We've talked about this question about whether bonds will act as the ballast or the source of risk during a sell-off period. That, I think, is going to be an increasing question as people consider whether preemptive rate cuts will actually keep growth and inflation higher.
Gold, record highs.
I know.
You've got company.
I do.
A lot more people coming on the show in the last week making the same point.
Yeah, but someone's going to look down the barrel and say, gold, really, Lisa? And, you know, they could be right.
Mark Zandi and Moody's.
You know, and they could be right. Maybe this is just a peripheral kind of reading, but that has strengthened for consecutive days to record highs in tandem with higher yields, in tandem with some other concerns percolating on the edges that maybe we will get some sustainable inflation.
Another record high on gold this morning, up 0.1%. Coming up this hour, we'll speak to Marianne Bartels of Sanctuary Wealth as the S&P 500 hits a new record high. Scott Ciccarelli of Truist on why he's snapping up Walmart shares and leaving Costco on the shelf. And Victoria Fernandez of Crossmark on why the path of least resistance for stocks is higher. We begin this hour with stocks coming off their 41st record high close of the year so far, propped up by Nvidia and tech as traders shrug off much weaker than expected consumer confidence numbers. Marianne Bartels of Sanctuary Wealth seeing more room to run, saying our bullish view on stocks just got even more bullish thanks to the Fed's 50 basis point rate cut. The Fed is also planning future cuts, and this is extremely bullish for stocks. This gives me confidence that the S&P 500 has the ability to reach 6,000 before the end of the year. Marianne joins us now for more. Marianne, welcome to the program. When I read things like extremely bullish, I'm not thinking about 5% upside. I'm thinking about 10, 15, and 20. How much more upside is in this equity market?
Well, I can still get the equity market up to 7,000. That's my highest target, not for this year. I do think we can get to 6,000 this year. So I can still get the market up 7,000. I think these rate cuts that are going to come down the pike are really going to continue to fuel this bull market going into next year.
Okay, so what's this going to be driven by? Ongoing small caps and the equal weight, or is this going to be participation all around because it's soft landing nirvana?
Well, you do have a broadening of the market. Like if you look at industrials, that's one sector that's on the cyclical side is really liking the rate cuts, also liking the stimulus from China. We have not seen tech as the leader since the correction, but my sense is that they will resume their leadership within this market. And semiconductors being the key leader, I call them the leaders of the pack. So I haven't given up on the leadership of tech because historically, if you lose your leadership, you lose your market. I'm not looking for small caps to, you know, it's like when the tide rises, all boats lift. Small cap can certainly go up, but I don't see it as leadership within this market.
There's a real question that we've been analyzing this morning about inflation and whether we're starting to see the seeds of maybe some fear creeping back into markets with higher yields in the long end. Do you believe that this is actually a reflection of potential reinflation types of scenarios down the pike, particularly what's happening in gold and yields? Or do you see this as just something of a head fake?
No, we've been in the camp that we are in a secular trend now for inflation, that in 2000 and 2001 were the secular lows for interest rates, and that interest rates are on a 20 to 30-year cycle of rising. I do believe sometime in the future we will see 10% interest rates. So I do think the back end of the curve is concerned about growth and inflation. Gold, I definitely believe, is picking up that we're now in a inflationary environment, but the cycle right now is for inflation to go down. So the long-term inflation is up, short-term the inflation cycle is down. And what I've been telling people is I do think rates at the short end of the curve can drop pretty dramatically. I think we can get the 2-year at some point down around 2%, 1.5%. I do think over time the 10-year will go down. But what I think is key here is if anybody needs a mortgage, anybody needs to refinance, anybody needs a loan, when rates drop, this is going to be your last opportunity to lock and load.
I'm just trying to square this idea that you could see the 2-year going down to a 1 handle or 2%, but also seeing the seeds of a soft landing and potentially 7,000 on the S&P 500. Don't low rates like that imply some sort of accommodation akin to a weak backdrop?
You would think so, and I would think that to be the case, but not if the Fed cuts aggressively and hints that they'll cut aggressively, because the market will move for them. It could be that the first half of the year is good and we see a pickup in growth in the first half, and then we see weakening in the back end. But I think this has more to do with the Fed having an easy policy than a significant slowdown in growth.
In June, you wrote a lot about the utilities and real estate and how you wanted to get in on those trades. Is it too late to buy into those sectors?
No, I think TINA's going to come back. I think sometime next year we're going to be talking about TINA, especially if rates go to the levels that I think we're going to go to. The market has been hunting and pecking for yield actually back since June. We actually got strong buy signals on utilities and REITs back in June, and I still think the market will, or investors will seek out yield within this market as yields go down.
Marianne, bulled up. It's going to catch up. Marianne Bartels there of Century Wealth on this equity market. TINA's making a comeback next year. What do you make of that?
I make it, they're basically, this is a Fed that's got the markets back, and that is the white hope, the white knight hope out there, that essentially you're going to get rate cuts in advance of weakness that will stave off that weakness, and that is what this market is leveraged to, which is the reason why yesterday we saw that 50 basis point rate cut in November being priced in on the heels of a subset of the conference board data. So a lot of this kind of goes to the feeling that people are hoping for a lot of heavy lifting from the Federal Reserve.
Stuart Kaiser of Citi yesterday. If the economic data begins to justify larger rate cuts from the Federal Reserve, it gets harder, not easier, to be bullish, because that data is getting weaker, and that's a problem.
The big, I guess, sort of fly in the ointment here is this question of just how willing is this Fed to get ahead of any weakness? Is Austin Goolsbee the mainstream of this Fed, saying that they're hundreds of basis points away from neutral and they've got a lot to cut just to even be okay, not necessarily even accommodative? That's not clear. And I think that if the rest of the Fed agrees with him, then frankly, the bull case that for cuts, even without that weakness.
Super strong.
Super strong.
Couldn't agree more. If Goolsbee's the Fed chair, limit long.
Yeah.
200 basis points north of neutral, let's get there super, super fast. We think we're super restrictive. We don't need to cut 200 basis points. We don't need weak data to do that. It's basically what he's saying, right?
Well, yes, and if you get that kind of scenario, then essentially you've got a Fed that is greasing the wheels for a recovery before we get a downturn. And that, I think, is what a lot of people are basically levering up to.
Lots more Fed speak through the week. Let's get you an update on stories elsewhere. With your Bloomberg brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. China conducted a rare missile launch into the Pacific Ocean in what appears to be the first such test in 4 decades. The nation's military confirmed an ICBM was launched with a dummy warhead and fell into the expected area without offering further details. China said it notified relevant countries in advance of the launch, but an official from the Japanese government said his nation received no such notice. The National Hurricane Center issued watches and warnings across Florida as Tropical Storm Helene continues to strengthen. According to the latest advisory, the storm is expected to be a major hurricane by the time it makes landfall Thursday night along the northeast coast of the Gulf of Mexico. And the man who was found hiding in the bushes with a loaded rifle at Donald Trump's golf course in Florida has been indicted for attempting to assassinate the former president. According to an indictment released yesterday by the Department of Justice, Ryan Ruth was charged with attempted assassination of a major presidential candidate, possessing a firearm to attempt to commit a violent crime, and assaulting a federal officer. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, some Morning Calls Plus. Scott Ciccarelli of Truist on why he's bullish on Walmart, but pulling back on Costco. That's next. This is Bloomberg.
is on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Equities right now pulling back by 0.06% on the S&P 500. Bond yields higher by 4 basis points. The 10-year 376.97 got close to 380 yesterday, breached that level, pulled back again after consumer confidence came in weaker than expected. The next big data point for this market, jobless claims tomorrow morning, 8:30 Eastern Time. Let's get you some morning calls. First up, TD Cowen downgrading Expedia to hold from buy. The analyst saying its consumer business may take longer than expected to turn around. Your second call from Morgan Stanley, cutting General Motors to underweight. The analyst forecasting increased market share loss through the end of the decade. GM down by 3.4%. And finally, Barclays upgrading HPE to overweight from equal weight. The analyst citing signs of a recovery in enterprise service. That stock still lower by 3.4%. Let's turn to retail. Scott Ciccarelli of Truist upgrading Walmart to buy, citing its increased market share across all income levels. However, he's downgrading Costco to hold due to changes the retailer has made to its shopping experience. Scott joins us now for more. Scott, welcome to the program. Let's start with Walmart. What are they doing? How are they executing that gives you a little bit more confidence in the name?
Well, I would tell you that they've always been a low-cost leader, okay, and so they've had that kind of reputation with consumers. But I think the big change with Walmart has really been continuing to roll out various convenience options, and whether that's home delivery, curbside pickup. You know, they had this membership program, basically Walmart Plus, and then all sorts of derivatives off of that. So any kind of resistance you have had to shopping at Walmart, they've kind of knocked them down. And, you know, against other, call it convenience-based retailers, they've really been able to narrow that competitive gap by really being able to service customers no matter how you want to shop.
So Costco, as you know, is not just a relative trade. You know, changes the retailer has made to its shopping experience. What is it about the shopping experience of Costco right now that you think is harming consumption at the stores?
Yeah, so to be, completely, for full disclosure here, like it's partly a valuation call. I mean, the stock has added $160 billion to its market cap in the last 12 months without any real change in their growth trajectory. But on top of that, to the point you just made, they have made some changes. As an example, they're rolling out scanning people's membership cards on entry rather than people just walking in and just showing their membership card. And we think at the margin that could have a negative impact on the company. When somebody who comes in and that there's what's called friend groups, kind of sharing a membership, maybe there's 4 people and, the one person, has the membership ID, maybe one other person signs up. So you could have an acceleration in membership signups, but maybe 1 or 2 of those people that were buying stuff before, they're going to stop buying. And so, again, there could be a negative ramification for a stock where I just don't think there's a whole lot of room for error at this stage. The other thing that if you go through some of the various forums, people are talking about their rotisserie chicken. It's an iconic product from Costco. It's still $4.99 after, all these years. And yet they've changed the packaging and people are complaining that the product's a little more soggy, that the bags leak, et cetera. And so, again, it's not necessarily a game changer, but again, for a stock that has very little room for error, it's changes at the margin that not everyone's going to love necessarily.
Before we move on to Walmart and just sort of compare and contrast, just to develop that a little bit, how much business do you think they're going to lose as a result of password sharing crackdown, which is essentially what they're doing, or card sharing crackdowns?
It's really hard to tell. I don't think they actually have a great idea of how many non-members are shopping there. I mean, the anecdotes would suggest that people certainly are not members and do shop there. So again, what I'd be concerned about as an investor at these valuation levels is any kind of moderation in the sales levels. You know what? That could wind up being a negative catalyst for the stock when you've had that much appreciation in such a short period of time.
There's a problem, I guess, if that is the narrowing kind of gap between potentially a beat or a miss when it comes to earnings revenues, which is the reason why every company, retail, airlines, et cetera, wants to become a credit card company, wants to also become a shipping company, also wants to become something having to do with media and tech. How much is that what distinguishes Walmart from the likes of Cisco, that they can be an advertising company too? They can also be an ad-driven kind of sales machine.
Yeah, well, when we're talking about Walmart, I mean, I think they kind of saw the model that Amazon created, right? And so Amazon, whether it was AWS, their advertising business, the logistics business, they all become higher margin revenue streams that can help subsidize the core retailing business. And I think Walmart's basically taking a page out of that book. Because if you look at what Walmart's doing and some of the numbers that they've given us, some of it's opaque to be fair, but some of the numbers that they've given us, it is much higher margin than their core retailing business. You could make an argument their core retailing business is operating down at like a 3% operating margin, several hundred basis points below what it used to be. And a big chunk of their profits now are, probably 30, 40% of the profits are now coming from these ancillary revenue streams. And again, what you can do with that is drive margins higher, so good for investors, but also help subsidize that retail business, drive prices lower to open your price gaps against competitors, which again helps reinforce that flywheel, which they can utilize to continue to gain market share.
Scott, what was it about Walmart, the catalyst, that really now means that they are this destination across the entire income cohort?
I think it's probably the convenience options. Again, they've always had kind of that low price focus. They probably, let's call it, got religion on, kind of really driving wider price gaps probably 6-7 years ago. But it's the convenience options that I think just breaks down those barriers. And again, whether it's the home delivery as they build out their Walmart.com business, the curbside pickup, they've rolled out the Walmart Plus membership, very similar to what Prime has done or Amazon's done with Prime. And so again, they've just increased that convenience factor so dramatically that people that may not have shopped at Walmart before can now shop at Walmart, and they feel good about it because they can get good prices and they can have home delivery if that's what they want.
They appear to be taking share from the dollar stores as well. It's not just trade down, Scott. I want to talk about some of the dollar stores with you. You wrote this about Dollar Tree in the last few weeks. Investors expected a mess, and that's what they got. But you still like this stock. Can you walk me through why you'd still buy this name this morning?
Basically valuation. Like I think the stock has been taken down to the point where it just isn't super logical in terms of where investors are treating it. But have they lost share? The answer is yes. Like they purchased a company called Family Dollar, probably almost 10 years ago at this stage, and they haven't been able to turn it around. They had they had activist investors come in. They brought in new management, in fact, management that was very successful at turning around Dollar General back in 08, 9, 10. And they just haven't been able to pull it off. And at the same time, you've had Dollar Tree, where they've changed pricing. They've tried to implement, higher price points within the stores. And, it's been with mixed results. But Dollar Tree ultimately is a pretty good business. It's differentiated enough from a Dollar General, from a Family Dollar, from a Walmart or Target that I think it should deserve a better valuation than I think what's being afforded in the market. So honestly, it's been a poor call on our part and, some other investors as well. But, it just doesn't make logical sense to downgrade the stock where it is today, in our opinion.
Scott, I just want your thoughts on something that's really bugged us over the last few months or so. When we hear from these companies, it just sounds like the low-income shopper is on his back, is really struggling, things are terrible. We never hear the CEOs talk about poor execution. How much of it is just about the low-income shopper struggling, and how much is it just about poor execution at the management level at some of these stores?
It's pretty hard to, kind of divide the two. The low-income consumer started to really turn negative in 22. It got worse in 23, and you could make an argument it's worse again in 24. So there's a compounding effect that, I think has, had ramifications across the spectrum of any company that really has any kind of exposure to that low-income consumer. But in terms of execution, there have been missteps. And I would tell you that a lot of companies are still struggling with the aftermath of what happened with COVID. You had, shutdowns, and then you had this massive surge of demand. Well, what else happened? You had people job hopping. The job market, was super flush. And so people could walk across the street and get an extra $1 or $2 an hour. And so all of a sudden you had turnover rates increase at all the stores. So what does that do? Your execution within the store tends to diminish. You tend to have higher shrink rates because people don't know exactly how to watch the stores. I have to pay more. So there's a lot of ramifications to that.
Scott, this was awesome. Let's do it again soon. On the retail sector, Scott Ciccarelli there of Truist. Coming up next on this program, Laura Rame of FS Investments and Victoria Fernandez of Crossmark. And as the UN General Assembly continues, Nobel Prize winner and economist Professor Joseph Stiglitz speaking at the Bloomberg New Economy event. Let's take a sneak peek.
It was, and indeed it was. Bush could look in the eyes of Putin and say, there's somebody I could trust. But I think the rest of the world didn't feel quite so comfortable. So, there will be an adjustment from hyper-globalization in both parties. But the difference is one in which I think Harris is committed to a global framework, working with what she views, with our partners, close partners of those, like our NATO allies, but also our partners in the South. And so it's trying to avoid a rupture and doing everything we can as we adjust our economy to embrace the rest of the world. So that's one. But the other one is, I think the way to understand Trump is his view of the world is a zero sum. And that means if the U.S. does better, other countries do worse, other countries do better. You saw this.
Countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
As we spend some time here on the broader presidential race,
let's focus in on European politics.
Makes you wonder how politics might play out.
Get your fix fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
Two-day winning streak on the S&P 500 coming into Wednesday. Your equity market looks like this. We are lower on the S&P by 0.05%. The Nasdaq 100 down by 0.1%. The Russell of small caps just about unchanged. 60 minutes away from the cash open with your morning movers. It's Manus Cranny. Morning, Manus.
Jonathan, good morning. General Motors is on the back foot this morning. Morgan Stanley downgraded the stock to underweight from equal weight. This is the second slashing of this stock this week. Earlier in the week, I brought you Bernstein's view. They may need more capital. But this is a much more holistic view from Morgan Stanley, which is the consumer is stretched. Inventories are on the upward trajectory. And, of course, affordability remains out of reach. So we're at some kind of a tipping point in the auto sector. The M&A action that Morgan Stanley thought was going to come through, those combinations just simply haven't played out. So two strikes on General Motors this week. Let's roll it over and talk about KB Homes. I almost want to move past the headline numbers, which is softening demand, mortgage costs are high, choppy demand in the summer. Boom. Boom. Look at refinancing today, up 20% last week after we saw those cuts. We've had 5 straight weeks of mortgage applications rising. So, okay, this is on the back foot this morning because simply their numbers are there. But if you look through the guidance today and you say, how does the housing market shape up into the back quarter? Maybe there's a release valve. I'll leave you with DoorDash. This has gone to overweight at KeyBank, $177. So you're looking at 25% on the upside. They're gaining ground in a lot of the verticals. I leave you with the concept of vertical integration at DoorDash. You can restock your minibar. I didn't know many people had minibars at home.
It's a New York City thing, Manus.
Ah.
Very New York City thing. They love the minibar. Love the minibar and the booze.
Are you
It's
New
just
York
not,
City?
don't see it in the UK as much.
It's very much a United States thing.
Just letting Cranny know he's
Yeah.
moved to New York. He's a recent,
Yeah.
guest of ours here in America, and I'm just letting him know.
Yeah, it's a big
relative to
thing.
London, bar carts are a big deal.
Yeah, bar carts. If you live in a house, you can build your own, and there are different designs.
Usually in houses in America, you have actual bars
Oh, that's true.
downstairs in a basement.
You sometimes have a bar,
Yeah.
but you also have mini bars. I am not an expert.
You guys are
but
hanging
I
out with
can
Tom
decide.
Keane too much. He has like a proper.
I'm aware. Yeah, Tom Keane and friends.
All I can say.
There's a lot
It's a
on the
normal
minibar.
thing for the United States. Let's just
Thanks
leave
for
it
outing
there.
Tom Keane, Anne-Marie. That's good. All right, the S&P 500 touching a new record high with more data on the strength of the economy due this week. Laura Rain of FS Investments saying this: it's the ironic problem of overly optimistic economic expectations. When so much good news is priced in, markets can be rocked by any downside surprising growth, even an incremental slowdown to a more sustainable path. Lara joins us now for more. Lara, this is how we started the program, and I guess we're going to end it this way as well. Do you think we're really vulnerable to one weak jobs print in the next few weeks?
Absolutely. I think markets are now laser focused on this job section. Unfortunately, we're condemned to be focusing on claims every single week now for probably the next quarter. The Fed is clearly in rate cut mode, but markets have priced in so many rate cuts, not just this year, but next year. And I think it's really going to be an issue for stocks because look at rates have fallen 100 basis points and equities are kind of still where they are. Price to earnings ratios are kind of haven't moved higher. So this is the issue. We've gotten just so priced for all of this good news and rate cuts. And I think markets are vulnerable here.
So where do you think that leaves the bond market cool at the moment?
I think we've seen the bulk of the long duration move because here's my outlook. We're going to have an incremental slowdown, growth closer to 2%. This is nothing radical on the growth front, but for equities where they are, for how many rate cuts are priced in, I think the bond market is due for a disappointment. Look at the 10 years up 10 basis points since the Fed cut rates. There's a reason for that, right? Because the data just are not showing us a recession. They're just showing an incremental slowdown.
Somebody might be listening to this and saying, but there are reasons to like things even if you don't like the macro backdrop and how things are priced. In particular, the fact that stocks are less and less correlated to the macro backdrop, given that so much is tied up with NVIDIA and Apple and Microsoft.
There's no doubt that concentration is a big issue. And listen, you know, the equity market is a reflection of the fact that the U.S. is still, you know, the only game in town in the global economic slowdown. And that we're just seeing still, you know, I think a lot of hope around AI. Rate cuts are priced in. But I think we need to differentiate between equity markets and the underlying economy. The economy can easily absorb an incremental slowdown, whereas equities, I think, are really increasingly reliant on this really aggressive rate cut trajectory to maintain valuations that are very high by any historic measure.
So Laura, you don't like stocks, you don't like bonds. What do you like?
I like bonds. I just like looking deeper into credit, because when we think about the underlying economy, there's just so much, I think, still robust strength there. You know, valuations are overstretched in publicly traded markets. They're much more reasonable in the private space. And as rates come down, we're going to see an increase in M&A activity. We're going to get a natural lift in a lot of other parts of the economy. They're going to get some relief on maybe middle market companies that have been challenged by higher borrowing costs. I think there's a lot to like out there. It's just that we're really looking expensive in those publicly traded equity space.
Laura, appreciate the update. Laura Rain there of FS Investments, the latest on the market and the economy. This from Andrew Honhorse of Citi, the daily update. Jobs hard to get, makes for hard landing. Take a listen to this. The percentage of individuals finding jobs hard to get is rising. This confirms that the rise in the unemployment rate is not good news about labour supply, but instead an indication that hiring is weak, an argument he's been making for quite a while.
And I understand that point, especially when we talk to people who study the companies and their earnings recalls, and basically they're not hiring. So even if they're not firing yet, they are not hiring, and there's going to be job losses for attrition. Whether this leads to a hard landing is debatable. He's been talking about this for a while. That said, that is not being priced into the market. And that, I think, is reason why people are looking at non-farm payrolls as potentially another sort of chink in the chain fence. What's the
I don't know what you're saying. Carry on.
The chink in the armor.
Okay.
Thank you, control room.
Did the control room save you? Did they? Nice. Joining us now is Victoria Fernandez of Crossmark. That's a new one. You're getting help from the control room now. All right, Victoria, welcome to the show. The path of least resistance is higher for stocks. Where does that come from based on the economic data we got just yesterday morning?
Well, I think, you know, it comes down to what you guys were just talking about when Lisa was saying a lot of the concern that's out there in the market, which I see as well in regards to the labor market, in regards to top line growth and earnings. It's just not being priced in. The market is really kind of on this high after this 50 basis point cut that, hey, there is a Fed put in play. Powell is not going to let this economy have any kind of a hard landing. And so the market is just off to the races. I mean, we've had some negative economic data, but yet we've had 2 new highs this week alone in the markets. And so I think you don't want to stand in the way of that train that's coming down the tracks, but I do think you want to be cautious. I don't think that the economy is going to do as well as the market is pricing in. I think it's getting a little bit over its skis, but in the near term, I think you want to ride that that train a little bit.
Is the enthusiasm hanging, though, on one data point, just jobless claims and what happens with layoffs? Is that what this all hinges on?
Unfortunately, I think a lot of it does ride on that one number. I would hope that the market would actually look a little bit deeper. Y'all have been talking with me all year about digging under the hood in the labor market. Don't just look at that claims number. Actually, according to Challenger Gray and the data we're seeing there in terms of layoffs, it looks like claims will probably bottom in October and then start to move higher. And I don't think the market's anticipating that. Anne Marie was talking about labor differential. We have been watching that so closely. You look at those numbers coming out of the conference board, it's 8 months in a row that number has been deteriorating. Quits are down, hires are down, temporary hiring is down. Those are all like leading indicators within the labor market. And one of the things we watch the closest, Jonathan, is cyclical employment. Don't just look at the regular payroll numbers. Take out the healthcare, the government, the education, and look at the cyclical component. That has been steadily declining. And in every soft landing we've had, that element has been moving higher, not lower. So I do think we need to look at some other areas of the labor market, not just the payroll number.
So what are you doing, Victoria? Are you basically buying gold and buying long bonds?
You know I love bonds, Lisa. We have that connection there. I'm a bond girl at heart. I think you do have to, like I said, participate in this equity market, even if you don't believe the long-term story that it has priced in right now. You want to partake in the upside of the market. So you look at some of the elements where you've seen some leadership changes. Look at financials. Look at some of the staples, healthcare. Those are areas we've been talking about for months. But yes, add some fixed income in there. Have rates come down a little bit? Yes, but you're still getting strong yields in the curve. So you want to move out a little bit. I know someone a minute ago said long duration is probably done. I would lock in some of those rates because you have heavy resistance at a 3.90 or 4% on the 10-year. And you also want to add some income generating components outside of fixed income. Look at covered calls, look at dividend plays, look at long short portfolios that are just trying to beat cash. Those are some elements that give you diversification because we think there's going to be a lot of volatility.
Victoria, how much do you give credence to this idea that we're seeing a tick up in the long end of the yield curve in terms of yields moving higher because there is a concern about inflation being stickier because of what the Fed is doing?
Yeah, I think it's twofold. I think you see that longer end of the curve moving higher, one, because people are pricing out the idea of a hard landing and they're all in on that soft landing. So you're seeing yields move a little bit higher on the long end for that. But it also has to do with the inflation component. Look, we have said for so long that that sticky part of inflation we think would keep the Fed from moving very quickly. I was actually surprised they went 50 basis points for that point alone. Look at prices paid in the PMIs this week. You had prices paid move up to 6-month highs, both on goods and services, and input cost on services were at 12-month highs. So I don't think we're out of the woods on inflation, and the longer end of the curve is reflecting that. And I know you were talking about mortgage rates earlier, and I hate to say it, but mortgage rates are highly correlated to that belly of the curve, that 5 to 7 year, and we're seeing that move higher as well. So I'm not sure we're going to get a boost from the housing market because of this.
Victoria, if you're worried about inflation, I mean, you sound a little bit like the Fed Governor, Mickey Bowman, who's talking about that she wants to take this measured approach because she's also concerned about inflation. Do you think then you're setting up for November to be a 25 basis point cut, or you think you're lonely?
Yeah, well, I actually thought for a while that we probably wouldn't see a cut in November. I thought the Fed would be much more patient and just going 25 in September and 25 in December. With a 50-point move in this last meeting, it leads me to believe that Powell is going to be a little bit more aggressive. So I probably would have been someone to dissent as well on that move and would have favored 25 basis point. But it looks like if the economic data continues the way it is, they will do probably 25 in November, 25 in December. That's 100 basis points this year. I think that's probably more than what the economy needs, but it's what the market is expecting. It's what the market is telling Powell they want. So we'll see if he gives the market what it's asking for.
But earlier you cited about that metric when it comes to jobs, how it does feel like it is getting much harder to find a job. Isn't that what the Fed should be leaning to? And wouldn't that lead you to a cut in November?
I think there has to be a balance. You know, the 50 basis point move that they had at this last meeting, I think is enough. Let that, it's going to have a lag, right? Just like hikes had a lag, cuts are going to have a lag. You're not immediately going to see someone say, great, 50 basis point cut. Let's go, you know, buy a house immediately. Let's go buy a car. It takes a while for that to feed through the economy. So I don't think they should be making these big cuts all right at the beginning. Let it work through a little bit, see where we stand. If the economy is expecting GDP growth of 2.5%, they're expecting strong earnings, and that's what they're saying right now with the equity market moving higher, but yet they want really aggressive cuts. The two pieces of that puzzle don't really fit well together. So I think taking a slower path on lowering rates is something that the economy can handle and would be better from the inflation perspective. Hopefully that allows the cracks in the labor market to slow, but we still have a good handle with the consumer.
Victoria, we've got to leave it there. Thank you. Victoria Fernandez there of Crossmark on why the path of least resistance for stocks is higher from here. I think investors, most investors, the bullish ones, would take that mix. They'd take a better growth backdrop with fewer, bigger rate cuts from the Federal Reserve.
Oh, absolutely, because ultimately it's the economy, stupid, I guess what people keep talking about, and that's what definitely people keep feeling in the stock market. I just wonder what counts as a good economy and for who.
Sure.
Because we were just talking about Walmart, and I think about, okay, well, they're able to also become a tech company and an advertising company and a data company and all these other companies that give their margins padding to allow them to compete much more aggressively and consolidate their market share. This is the type of thing that's going on, so can you bet on that, even if the broader economy isn't doing so great?
And now we've got utility companies establishing a stronger correlation with tech spend and AI and data centers.
Exactly. So basically you end up with a non-correlated asset to some of the traditional metrics like bond yields that they traditionally were hinged to. It really creates a muddied backdrop.
What do we price for? Lisa Shallett, Morgan Stanley. With the drama around the Fed's first rate cut resolved, the power of macro dynamics to drive markets through upside surprises has diminished. Goes on to say, yes, Fed actions have increased the probability of a soft landing for now, but markets have priced all of that and then some. You said this earlier this week. I said, what's the risk? And you said, what aren't we priced for? And what are we priced for? Right now, we're priced for soft landing nirvana.
Exactly. We're priced for this idea that the Fed can take the Austin Goolsbee side of things, cut aggressively at the same time that you get sustained growth. Can this Federal Reserve be preemptive in its cuts with enough time to get that put into place without necessarily causing a reacceleration up to 7,000, as one guest was saying, or potentially triggering some new wave of inflation?
We're going to play this from month to month, payrolls reports and payrolls report for the rest of this year. Equity futures on the S&P 500, just a little bit softer, slightly negative here with an update on stories elsewhere. With your Bloomberg Brief, here's Yahira Hekos. Hey, Yahira.
Hi, John. Striking Boeing workers aren't interested in the company's sweetened offer to hike their wages by 30%. That's according to the Machinists and Aerospace Workers Union, which called the offer inadequate and disrespectful. The company angered the union by taking the offer directly to workers. Boeing tried to smooth things over by lifting the Friday deadline for workers to approve the offer after the union nixed the vote. Meanwhile, the Trump campaign says it's been briefed on, quote, real and specific threats by Iran to assassinate the former president. A campaign spokesman says a representative from the Director of National Intelligence told Trump about the plot. But there's no indication Iran's efforts are linked to the two recent attempts on the former president's life. And this is where our resident Mets fan, Mets owner Steve Cohen is revealing new renderings of a proposed complex surrounding Citi Field. The plan with Hard Rock Entertainment would convert the stadium's parking lot to a gaming center and music venue called Metropolitan Park. Cohen's team says the project in total will create more than 23,000 jobs and invest $8 billion in Queens. The idea still needs approval from key lawmakers and New York Governor Kathy Hochul to proceed. That's your Bloomberg Brief. John?
Yahira, thank you. Thanks for this morning. What do we think of that? Casino, Citi Field? Sound attractive to you? Enticing enough to make the trip out there?
Okay, hold on a second. You know what Citi Field means to members of my family. So I can't exactly, whatever they want to do, good for them. No, but don't make it a casino. It's a bastion of the American sport and the metropolitans that can bring people together of all types to really enjoy.
As Yankees fans here in Midtown of Manhattan would say, it's an eyesore on the way to JFK.
I could say the same thing.
Okay.
Going up on the 4 train.
All right. Anyway. Up next on the program, setting you up for the day ahead, plus Bloomberg's Ed Ludlow on his exclusive with Meta's CFO. We'll catch up with him in just a moment. This is Bloomberg.
Who is the Vivian Tom clientele?
Yeah, power women, like the dragon women. They're lawyers, they're CEOs, they're all important decision makers, women in the world.
Why do you position your products for this group of women?
When I started, designing, I always want to do something that is empower women.
When you take a look at your store, there is something for everyone. Take a look at the T-shirt, for example.
My customer growing, like 30 years already, so they become more powerful. I also want to grow my Gen Z audience too, they are like in the 20s, so it's a more affordable price for them. And then, my powerful women's daughter wearing their mom's dresses, and they feel that the power, the energy. So now they come back to the store and they buy more.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a 3
as the economic picture,
covering the intersections of Hollywood, Silicon Valley, and beyond.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
The opening about 40 minutes away. Equities basically unchanged on the S&P 500, just a little bit negative on the S&P. We're down by 0.06. The sell-off in treasuries resumes. Yields are higher by 2 or 3 basis points. The 10-year 375.45. The calendar for the day ahead looks a little something like this. The UN General Assembly continues today. We'll get more Fed speak from Kugler at 4 p.m. Eastern Time. Tomorrow, another round of jobless claims, plus earnings from Costco. On Friday, we'll get PC and UMich sentiment. Later on today, we'll get Micron reporting earnings after the closing bell. Let's catch up with Ed Ludlow for a little bit more. Ed, I know you've got a big conversation coming up a little bit later. I just want to kick off with those earnings. What are you and the team looking for?
Yeah, I think beyond the idiosyncrasies of what Micron does, it's a great crystal ball of what's happening across many industries in the world of technology, right? There's the AI bit, and as we build out data center infrastructure, high bandwidth memory chips that surround the GPU are really important. And what's so weird is they're proportionate. So for every piece of NVIDIA tech you have 7 or 8 corresponding Micron chips. But if you look at the stock, that's not the case. Why does it not get the corresponding equity market love? But also, Micron is at the core of very cyclical industries. And I think we'll learn a lot this evening, John, about the state of the world we're in.
Ed, one of the biggest stories, I think, of the last week, and maybe the year so far, the fact that we've restarted a nuclear plant in this country and have pledged to give the energy to a single tech firm in America just makes me feel like this is the start of something much, much bigger that we need to pay more and more attention to. How big is this for you?
It's big because I think we don't really appreciate the number of parties involved. So nuclear power, yes. How many CEOs do you know that have a customer that will go up to them and say, I pledge to pay you for the next 20 years? That CEO of Constellation has that deal with Microsoft. How wild is that? But then think about all the REITs that are involved in the financing of literally bricks, mortar, concrete in data centers. And the energy component is relevant to that as well, because you have all of the cooling systems involved. That brings all the HVAC names. I think we're going to start to have a much bigger picture of what's happening here because of the sort of less attractive names in the cycle. And nuclear power is a big part of that story because we need to find the energy from somewhere.
And we need to understand exactly how this whole field is evolving, Ed, which is the reason why I'll be tuning into your interview later today with the Meta Chief Technology Officer. A real question about how they see AI functioning at a time when they've had to go back to their bread and butter, not necessarily the metaverse and some of their more moonshot plans.
Yes, but I've experienced something this week, and I've been reminded of something, which is my job is to serve the Bloomberg audience. What is the news? How does it impact the investor? But please remember that these are technology companies, And I think the reason that your audience should tune in this afternoon is that you will see a technology company that's actually pushing the boundary on hardware and software. That's all I can say for now. It is astonishing. And then the question is, have they done enough on the thing that they're going to show this afternoon to convince investors that they have a clear direction? It's astonishing, guys. So.
A little bit worried about you that you'd put on one of those virtual reality headsets and had an out-of-body experience. But we'll tune in, I promise. Ed Ludlow, coming up a little bit later. Bloomberg TV, 4 p.m. Eastern Time. Ed's interview with Andrew Bosworth, the Meta Chief Technology Officer. You got thoughts?
Well, look, putting aside, we'll all be tuning into the interview. I am curious about how they're trying to think around some of the artificial intelligence aspects. You talk about the energy use, and I want to pick up on that.
Sure.
How do they end up making it more efficient? Because ultimately, it's going to have to come down to that. If you think about a company that's going to end up with a line item that's going to be funding a nuclear power plant, potentially, you're going to imagine that they have an incentive to increase the efficiencies of some of these neural pathways that they're creating. Basically, make it less energy intensive.
On the sidelines of the UN, I know we're joking about the traffic. Actually, AI has been such an important conversation. You think about this Microsoft deal. Sam Altman went to the White House to talk about the fact that they're going to need government help when it comes to powering and the energy need to really service these data centers.
Where is this energy going to come from? How many more of these stories are we going to see in the next 12 months?
Probably a lot. And you imagine that Microsoft isn't alone. Whatever Meta's going to announce later today, we'll find out. But, you know, maybe they'll also be...
What was that about?
No idea.
We'll find out.
I'm not sure where he was going with that.
There's quite a tease for that interview.
Yeah, well, you know, I could say, he's like, normally it's to serve the audience. I've had a...
He's had an experience.
He had an out-of-body experience.
Right.
And so hopefully we will find out why.
It's one of those reality headsets.
Yeah, the virtual, like an Oculus play?
Yeah.
I think that this felt deeper than an Oculus. This transported. But there's a real issue here about how it also limits the barriers to entry, because you have to imagine that a tech company has to afford to pay for said power. Again, this goes down to consolidation in the biggest players and how you sort of deal with that.
Tune in to Ed's Experience a little bit later on Bloomberg TV. Coming up tomorrow, Evan Brown of UBS, Jerome Schneider of PIMCO, Rio Tinto CEO. Look out for that. If you want a read on China, talk to someone who's got a big business in China. That conversation tomorrow morning is must-watch TV, and we'll speak to the NATO Secretary General, Jens Stoltenberg. Big lineup coming up tomorrow. Right now, your equity market on the S&P 500, just about unchanged. In the bond market, yields continue to climb. On a 10-year, we're up by 3 basis points, 376. And if you have to trade this, you have our thoughts. Euro dollar, 111.96. Just about unchanged on the session. From New York City, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working. Then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting at Bloomberg to talk about sustainability, about future of sales. No, myself 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
There are many global investors that aren't interested in China anymore, but there's a lot that are. And obviously the local investors have money in China and are doubling down on investing in China. Many of the Asian investors, and in fact a lot of the Middle East investors, the Americans are gone away. Therefore, there's an amazing opportunity to put capital to work and get returns which are excess what you would get in other places. Where there is lack of money, there is usually opportunity. So we continue to build out our business in China. It's just where the money's coming from is different. And so we're raising local money in China for investing and bringing those that choose to be there to invest in China. So it's just a different, where the money's coming from is just different.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
All right, letting a little air out after yet another record close yesterday for the S&P futures. 30 minutes until the start of today's trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, stocks are set to slip after the S&P 500 posted its 41st record of the year. Goldman's David Kostin told us he sees more upside, and today we're going to get the view from Deutsche Bank, BlackRock, and JP Morgan.
And autos are in focus as Morgan Stanley downgrades General Motors, Ford, and Rivian, citing headwinds, including China. In the next hour, we'll get insight on the luxury sector from the CEO of Rolls-Royce Motor Cars.
Plus, two key earnings reports after the bell today. We'll get an AI update from Micron and an early read on Wall Street results from Jefferies. All that and more coming up. Let's take a look at where markets are trading 30 minutes until the bell rings. Like Matt said, a little bit of a breather yesterday. We managed to close at a record yesterday, but today you take a look at S&P 500 futures, just slightly in the red. You could call that unchanged if you're an optimist, but the color is red. A little bit more direction in the NASDAQ 100, your big tech names. The big tech benchmark currently down about 0.1% as bonds continue to sell off here just a little bit. You take a look at the 10-year yield, Matt, currently up 2-3 basis points.
All right, I'm looking here at U.S. stocks versus the rest of the world. This is on a valuation basis, and you can see that the valuation premium U.S. stocks hold is very high. If you looked inside that, you'd see a premium for big tech stocks over the rest of the industries in the S&P, and I'm going to ask Binky Chadha about that when he comes on in just a few minutes.
Hard to bet against America, but what about the American home builder? We're going to talk about home builder KB Home. It reported net orders for the third quarter that disappointed analysts and investors. KB Home's outlook for the year ahead was well above estimates. You do have the stock now down 5.7% pre-market. Also watching shares of Donald Trump's media company climbing after hitting its lowest level since 2021. The lockup period ended last week, but Donald Trump says he won't sell his stake. You see Trump Media and Telecom Group, Technology Group up around 3.7%. Also, remember this big auto call. Morgan Stanley analyst Adam Jonas downgraded shares of GM, Ford, and Rivian. Jonas says that the move is driven by a combination of international, domestic, and strategic factors. We're going to talk more about that this hour, Matt.
Yeah, can't wait to talk cars, but we have to start on the record, the 41st record, as Sonali pointed out, that we hit yesterday on the S&P 500. So stocks continue to be powered to new highs, and it's really still this big tech, NVIDIA play driving it. NVIDIA is adding more than 22% of the gains that we've seen this year.
And outside of NVIDIA, it just seems like there's very little fear in this market. If you take a look at the VIX, for instance, we're back back below 16 at the index level, very little demand for put protection here. So even with these records that we're inching to, it feels like every day, not really seeing the fear creep in, Shonali.
All is calm, all is well. And what's interesting, you saw yesterday a little bit of fear in the market after that consumer data came out, weaker than expected. However, the market shrugged that off. Let's see if that trend continues.
All right, joining us at the table is Deutsche Bank Chief Global Strategist and Head of Asset Allocation, Binky Chadha. And Binky, you have nudged your target up for the S&P to 5750. We're near as damn it to it right now. So what happens for the rest of the year? Do you just sit back and...
So I think the question for the equity market is, are we going to get the typical, pre-election pullback? I think historically in close elections, the playbook is very clear, starting about a month earlier. So that's the first week of October. The market has tended to sell off 4 to 5%, and then
in an election,
in a close election year, in the month prior to an election. So we've just had 2 back-to-back pullbacks. Yes, we are at a new high, but we're just sort of like 1% above where we were, at the mid-July peak. So we haven't really done that much. And our baseline view is, there's a strong potential for a pretty typical pullback before the election, as typically happens, as investors basically buy protection for potential volatility around the election. And as long as you get a clear resolution, if it doesn't have to be that night, it doesn't have to be by midnight, but as long as you get a clear resolution, the market has tended to rally as that premium comes out, basically, regardless of which candidate wins. And so, I think about the elections as there's a very familiar most people are familiar with what's called the dollar smile. So I'm picking a different asset class here, which is things do this in a range, but once you go out of the range, things change or the relationship changes.
Right.
And I think that sort of applies here because, yes, the election premium should come out, but obviously we've got 5 weeks till the election. So the question is, how is the market going to behave if the polls start to move?
Well, Binky, marry that sort of typical playbook that you see, of course, a little bit of a pullback into an election and then maybe a rally coming out of a clear resolution and emphasis on a clear resolution. When you marry that against the macroeconomic backdrop, of course, what we're seeing when it comes to fundamental earnings power from corporate America, does it make sense then that you would want to buy that pullback that you're expecting?
That is correct, but buying a pullback is easier said than done because you've got to pick your point. If you buy too early, you're still going to lose some money. You buy too late, you already lost some if you took it off. And so, from a medium term, which is a 3-month point of view, I would just sort of stay steady is the way that I would put it. But yeah, I mean, it argues for buying the pullback at some point. We get, past 5 to 7%. Yeah.
Well, that was what I was going to ask. How much of a drawdown do you really see? How much of a pullback do you see in this market? And also, where do you buy?
Yeah.
The S&P equal weight hitting a fresh record, but the NASDAQ 100 still off of its highs.
Yeah, so I think there's little doubt. I mean, you guys were just talking about equity valuations. They're on the high side, but I would say they're sort of pushing the limit of fair value or deviations really from fair value. We think fair value in the S&P 500 is about 18 times earnings. We're trading 22, 23 times. A 4-point deviation is pretty typical as the market price is in a recovery or a decline. And so we're sort of pushing that limit. But what I would keep in mind is that, simple way of thinking about the equity market is earnings come from the economy. So that's about the macro outlook. The PE that goes, the P that goes into the PE depends on a lot of other things, not just whether equity investors, think basically that equities are expensive. So we like to look at where equity prices are going, basically from what we call our very simple demand-supply framework. So we have changes in positioning, which of course gets all of the attention. But there is also, to keep in mind, equity inflows. So changes in positioning is changes in how existing equity mandates are getting managed. Then there's the new money coming in, which is equity inflows. And of course, we have the biggest player, which is the buybacks. Now, one of the things that's been very different this year is that we're getting very, very, very robust inflows into equities, and that's something to keep in mind. And when one thinks about valuation, all I'm saying is, the P is driven by the market. It depends on things like risk appetite, and risk appetite is strong, and it's likely to remain strong because if you think about the economy and the cycle and where we are, we're actually in a pretty unique place where unemployment's pretty close to 4%.
Right.
Most people would say full employment, but what typically does not happen when you're at full employment is having, 6-7 quarters of 3% GDP growth, which is what
but
we
also we had 6 quarters of earnings recession for the rest of the S&P, right? Everybody's bullish big tech, and like every guest we have on remains bullish big tech. I want to ask you about the valuations and if they're justified. Gina Martin-Adams from Bloomberg Intelligence says of U.S. large cap stocks, tech sector multiples are so extreme that consensus for sales would have to jump more than 50% over the next year just to meet recent valuations. Are we too bullish on this sector? And it's mostly chips and hardware. That's like more than half of it.
So I would actually argue that in the near term, so I'm thinking about 3 or 4 months out, basically, we already had a derating in tech, and I would argue the derating is essentially done for now. Where do I?
Well deserved. Look at earnings growth on the Mag 7. I think we have a chart showing that it's slowed way down. Right. And if you look at the forecasts, okay, they're all for, 18, 19, 20% earnings growth. There's the chart. But those are just forecasts, right?
Right. So I think the way you think about mega cap growth in tech earnings is there's a very, very clear trend channel for the last 25 years. And what we did is, I would say the earnings recession was actually in mega cap growth in tech, had very limited impact basically outside of that, exception maybe energy and materials, which is unrelated. And so what mega cap growth in tech earnings have done is gone from the bottom of the channel to the top of the channel from the fourth quarter of 2022 to the fourth quarter of 2023. Now, it's a very solid channel, but it's only 11% growth, which by any standards is very, very robust. And the point I'm simply getting at is we got 40% earnings growth in the fourth quarter of last year for them. We got very modest slowing, 38% in the first quarter of this year. But if they have the best possible earnings and they hug the top of the channel, which is what they've been doing, that implies 11% growth rate. And equity positioning in mega cap growth in tech was sort of aligned with 40% growth continuing. The good news is that positioning has been cut pretty sharply, pretty dramatically. It's sort of in line with what we are expecting in the mid to low 20s for the third quarter. So that's why I say, the necessary adjustment has happened. Now, we haven't adjusted down to 11%, but, as you also said, it's a forecast. So the market's not going to be in a hurry to adjust to what's going to happen at the end of next year. It's uncertain. So, but I think for now, it's kind of clear. And if you don't like all this fancy stuff about positioning and growth and numbers, just look at the NASDAQ 100 relative to the S&P 500. It's a very, very clear trend channel of outperformance. And we've just bounced a little bit from the bottom of the channel. So both things are saying exactly the same thing. For now, it looks to be done.
All right, that's a good place to leave it. Binky, really appreciate your time today, of course, breaking down big tech valuations, maybe a little bit more in line with, of course, the valuations when it comes to positioning. That is Deutsche Bank Chief Global Strategist and Head of Asset Allocation, Binky Chadha. Meanwhile, you take a look at futures right now, about 20 minutes to go until the bells ring. You can see still not too pretty out there. The S&P 500 pretty much unchanged, but not exactly in the green. The NASDAQ 100 0.1% lower, and the small caps trying to go green, trying to get a sustainable gain there. The Russell 2000 I'm going to go ahead and call that unchanged.
Nothing happening in futures.
I know. Maybe there's something happening underneath the hood. Let's get a look at those stocks moving ahead of the opening bell with Abigail Doolittle.
There certainly is, Katie. Let's start off with the shares of Flutter Entertainment, the online gambling holding company, popping sharply higher today, up about 9.2%. This as they provide a 2027 outlook that is really positive for the overall online gambling community. Here in the U.S., they're saying it will be $63 billion. That's 50% better than the prior outlook. This is also bringing up DraftKings. In addition, Flutter has announced a $5 billion buyback. One company weighing to the downside, though, ServiceNow, the enterprise software company, those shares down about more than 2%. We do have Piper Sandler saying that one of the companies that is caught in a DOJ probe, that this is a major revenue contributor to ServiceNow, about 40%. So those stocks, that stock down about 2% again, as there is a bit of an overhang. And then finally, one reason that the futures are hanging in there right around even. Take a look at the shares of NVIDIA and Micron. NVIDIA in particular up about 0.9%. So it does seem that investors to some degree are in on that AI trade today. I would note though, Shonali, NVIDIA still within a range. So it's not clear that the bulls are really taking this one higher, but at least today, a little bit of a relief there.
A lot of movement. Abby, have you ever put on a sports bet before?
I have not.
Well, you know, it's very easy to see as a new sports bettor myself exactly why FanDuel is making all that money on all those parlays. Now, coming up, we're going to talk about Boeing, a big offer here, but this plane maker still has a strike on its hands. That's up next. This is Bloomberg.
The names that move markets are on Bloomberg.
Our role in the world, our role in NATO in supporting the Ukrainians in this war, the unprovoked war that Russia has instigated in Ukraine, our support for the Indo-Pacific, for providing a counterbalance to China. All of that is in our interest, and whoever's president, I'm sure, is going to do what's in the best interest of the United States.
It is not a time for America to back off of its commitment around the globe. And I think there's a justification for us making certain that we do the right things in a way that we share the burdens with our allies. But I don't expect America to walk away from the world in any administration. It's about American security, and it's about making certain our adversaries, present and future, know that when America's committed to something, they're there for the long haul.
Bloomberg. Context changes everything.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power. This is Bloomberg.
Let's get to high interest now. Look at what's making headlines around the world. Israel is stepping up its heaviest air attacks on Hezbollah targets in Lebanon since 2006, with hundreds of people killed so far. The IDF also shot down the first missile ever fired by the militant group at Tel Aviv. The Iranian president spoke out against the bombing of Lebanon at the UN yesterday, condemning what he called Israel's crimes against humanity and called on the international community to intervene. Among the death toll yesterday, 50 children in southern Lebanon. Caroline Ellison was sentenced to 2 years in prison. The former CEO of Alameda Research was charged with fraud and money laundering after the collapse of crypto exchange FTX. Ellison will serve her prison term starting on or after November 7th. And OpenAI pitched the Biden administration on the need for massive data centers that could easily use as much power each as entire cities. CEO Sam Altman was among other tech leaders at a recent White House meeting with government officials. He used the opportunity to share a document outlining the economic and national security benefits of building 5 gigawatt data centers in various U.S. states. To put that in context, 5 gigawatts is roughly equivalent to 5 nuclear reactors, or enough power for 3 million homes. Shanali?
The union representing 33,000 Boeing workers on strike have rejected the company's latest proposal to hike wages by 30%, and it's describing it as inadequate and disrespectful. We're going to bring in Bloomberg's Benedict Campbell, who runs our global aviation coverage. You look at this latest offer Boeing has put on the table here. It's not quite meeting the initial demands. Is this a matter of leverage that the union has over Boeing at this juncture, or is this a matter of getting what they think is right at this point in time?
Well, at this point, the two sides still seem quite far apart. The union saying we have no interest in negotiating this latest offer. As you said, 30% is what's on the table from Boeing on wages. They've also sweetened a couple of other things, but this remains at least sort of 10 points below what the unions would like to see. Now, most people would think, well, 30%, that's a pretty nice sweetener on my salary, but you've got to remember that these unions feel that they were shortchanged in the last round about a decade ago. Inflation has really hurt a lot of workers, so they are out here to get as much as they can. And given the dire straits that Boeing is in, they probably feel now's a good time to do this. We're never going to have this window of opportunity again, so they are digging in.
It's a great point that 30%, obviously a huge number there, but you make the good point that you have to think about the base that they're starting from. I want to talk about what this means for Boeing. There was a really interesting analysis out from Jefferies estimating that basically the strike, it shut down production of the 737 MAX, other jetliners. It could drain an additional $1.3 billion in cash from Boeing each month. I mean, how painful is this for Boeing when you think about all the other issues it has right now?
Well, that's exactly the point. I mean, this is a company that went into this strike already reeling. I mean, we all remember what's been going on at Boeing since January 5th, since that accident on the Alaska Airlines plane. And since then, they've tried to sort of regain their footing, but it's been very difficult. They were sort of getting there slowly. The production of the cash cow 737 started inching up again, and then the strike happened. So they are in an incredibly difficult position here. And for them, in some ways, it's about sort of striking a balance between what will another sweetener cost us versus what does it cost us to prolong this strike. By some estimates, it's about $100 million a day that it's costing Boeing in terms of cash, and frankly, cash that the company does not have. In the first 6 months of the year, they lost $6 billion in cash flow. The credit rating is dangerously close to junk. So all of these things together put them in a very difficult negotiation position.
How much of this is about the bad relationship between Boeing management and union management? Because, you know, the union was angry, the leaders were angry that Boeing went around those leaders and actually offered this to, you know, the base, to the actual workers. They said it was disrespectful. But does it really matter if they're giving the workers what the workers want?
Normally, you would think, yes, there's a way to go about this, and you negotiate with the union, and then the union presents it to the workers. This time, Boeing took a bit of a gamble when they threw in this sweetener. They said, let's circumnavigate the unions, go straight to the workers. The trouble is, the offer they came with, those 30%, was a bit of a low-ball approach. So if you're going to do that, you might have to come in with something more substantial, really a sort of knock-it-out-of-the-ballpark type offer, closer to the 40%. Then they might have succeeded in driving a wedge between the workers and the unions. This way, it seems it's only hardened the resolves of the union and the workers, and it might be a bit of a miscalculation on the side of Boeing. It will be interesting to see whether they can sort of patch that up again, get back to the negotiation table. The last round, last week, they spoke with a mediator. Both sides say, we want to get back at the table, but at this point, there doesn't really seem to be a very clear resolution.
Benny, thanks so much. Benedict Campbell there, coming to us from our Berlin bureau, talking about the Boeing strike, because Benny has such amazing experience with the airline industry and airliner production. Coming up, the spice is spiked. Coca-Cola ditches its newest flavor. We'll have details in Social Climbers next. This is Bloomberg.
Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
All right, it's time now for Social Climbers. The company's making waves this morning, and first up, Paramount Global is cutting more jobs as part of a $500 million cost-cutting effort announced in June. The media company is paring back its U.S. workforce, mainly targeting employees in the marketing, communications, and technology departments. Next up, we have Stitch Fit's unraveling after the personal styling platform issued weaker than expected forecasts for the next year. Analysts, they're also disappointed by the company's projection that it will only return to revenue growth by the end of 2026. You can see shares currently down 29%, so traders clearly disappointed as well. And finally, Dr. Pepper fans can rest easy because Coca-Cola announcing today that it's discontinuing its spiced flavor less than a year after it hit shelves. The beverage, of course, it blended the traditional Coke flavor with raspberry notes, and it was the first alternative to the classic Coke that was offered in 3 years. The company didn't provide a specific reason for axing spiced. Of course, you can follow all the latest company buzz on TRE & Go on your Bloomberg terminal, but let's take a look at markets right now. Even though if you're looking for action, you're not going to find it on the index level. You can see the S&P 500, we're going to call that unchanged, maybe a little bit lower. Of course, it's not the slight gain we were looking at yesterday when we saw that 41st record high of 2024. Of course, taking a little bit of a breather. Same thing, too, if you take a look at the NASDAQ 100, currently down about 0.1% pre-market. Small caps fighting for it, of course. We were a little bit higher on the Russell 2000. Now we're going to go ahead and call that unchanged, Matt.
Why? What does spiced have to do with Dr. Pepper? Why do Dr. Pepper fans worry about...
Dr. Pepper is spicy.
But Coca-Cola Spiced had raspberry?
It was supposed to be a little bit spicy. I don't know. It's discontinued, so now we'll never know.
All right, yeah, we can't try it now. Less than 4 minutes until the opening bell. We'll focus back in on markets at BlackRock's Gargi Chowdhury next. This is Bloomberg.
make sure that we're exposed to categories that continue to be relevant to consumers, that we're positioned in categories where we have a competitive right to win.
By strategically adding and shedding assets, General Mills has turned over about 20% of its net sales base in the last 6 years. It's dramatically expanded its pet food platform, starting with the purchase of Blue Buffalo pet products in 2018. That expansion dovetailed with a boom in demand.
Pet in the U.S., pet feeding and treating, is a $50 billion category. It's almost 5 times the size of a category like cereal.
Is this the future of the company? I mean, we so much associate General Mills with breakfast and cereals, human breakfast and human cereals. Are we now going to be thinking about General Mills much more as a pet food company?
I think you'd be thinking about General Mills as a food company where we treat all the members of the family like family.
The humanization of pets is actually the biggest driver of pet food and pet treating growth. It has derivatives in not only feeding, which is the core thing that most households where most of the dollars go against the pet, but treating, and then you start to branch out to things like vitamins and minerals and supplements.
People really love their pets. They want to take care of their pets like they do their family, and it really is a global phenomenon. That's why we recently entered the China market with Blue Buffalo. That's why we bought Edgar & Cooper recently in Europe, because we see the same kinds of trends that have played out here in the U.S. playing out all over the world.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller. This market can be whatever you want it to be today. You can make something of this market. Right now, it's unchanged. It's just a blank canvas. So do something with it. S&P futures at 0. NASDAQ futures down 0.1%. Ringing the bell. This is pretty interesting. At the New York Stock Exchange, the president of the European Commission, Ursula von der Leyen, I'm not sure if it's official or if the New York Stock Exchange website just chose this. They refer to her as Your Excellency. Her Excellency, Ursula von der Leyen, ringing the bell at the New York Stock Exchange after the 41st record close of the year on the S&P 500. Katie, are we going to see a 42nd record close today?
You know, I don't know, but let's try to make something out of this market.
Katie Greifeld?
I'll try my best. An optimist might say we are very close to record highs. We got one yesterday. Maybe we'll get one today. A pessimist might say, I don't know, you look at this, you see a little bit of red for the NASDAQ 100, currently down 0.1%. The S&P 500, a little bit higher, 0.1%. Small caps, meanwhile, unchanged, really taking a breather after that record run that we've been witnessed to. Meanwhile, let's take a look under the hood where we do have some action. We'll start with home builder KB Homes. It disappointed with net orders for the third quarter despite lowering interest rates and an outlook that topped Wall Street estimates. That was not enough. Chanel, you take a look at shares right now, currently down by more than 5%.
Also, Katie, I know you're watching this one too. DJT, Trump's media company, rebounding from the lowest level in years. Trump has vowed not to sell his majority stake. We're going to talk more about that in a moment. And in the meantime, I'm watching Trump Media and Technology Group, third day of gains, 3.9% higher, Matt.
All right, Morgan Stanley analyst Adam Jonas downgraded a number of big automakers, including General Motors. You can see those shares are off, as are shares of Ford. Take a closer look at the auto stocks with Bloomberg's Abigail Doolittle. Abby?
Yeah, it's a big downgrade of the U.S. auto sector. GM taking it the hardest, down about 3.7%, at least from the standpoint, because at this point, Rivian is down about the same amount. From the downgrade standpoint, those shares were actually cut to an underweight. The other shares basically an equal weight. And the call is very, very robust. But at the end of the day, it sounds like Adam Jonas thinks that there's lots of headwinds against some of these companies, including a quote-unquote upward slope amid vehicle affordability, out of reach, that remains out of reach for many consumers. In addition, he's talking about credit losses for less than prime customers, also the significant CapEx commitment required for AI development. So lots of different factors here weighing on this auto sector today a part of this overall downgrade. These are among some of those factors that I was just mentioning. It's interesting, though, it's not all bad. He's actually upgraded the auto dealers. If we take a look at Auto Nation, we're going to see that these shares are popping sharply higher here in the pre-market, or on the open, I should say, up 1.9%. And this has to do with, it doesn't entirely jive in some ways, but they're upgrading the franchise dealer complex, deserving of a positive multiple re-rating due to positive brand and U.S. geographic exposure. So lots of different factors here. Katie, we'll be watching these stocks all day long.
All right, Abigail Doolittle, thank you so much. Of course, a big call from Adam Jonas, and of course, markets are listening. Let's broaden out this conversation now with Gauri Chowdhury. She is BlackRock Chief Investment and Portfolio Strategist for the Americas. Joining us on set, it's great to see you.
Great to be here, thank you.
So we were talking at the start of the hour about how it feels like there's not a lot of fear in this market. You take a look at the VIX below 16. You take a look at that bid for put protection. It's just not really there in a robust way. When you think about what we've learned over the past few weeks from the Fed, from the economy, from earnings, then you think about where we're going. What's the BlackRock view right now?
Sure, Katie, and a great morning to be here with you because we just published our fall outlook for Q4, and we're answering some of these questions that you're asking. What did we learn over the last, since the summer? And the big thing, I think, that is quite market changing, or at least for the near term, we think it's going to have huge ramifications, is this idea that the Fed is going to preserve the downside for now, cutting 50 basis points when the economy is still going to remain really strong, and then promising to do further if needed. And I think that has meaningful ramifications for an economy that's already at pretty strong holdings. So that's number one. The second thing that we've learned through the course of the summer, of course, is that inflation is making its way down towards that 2% level, which of course is really good news, allows the Fed to continue to feel comfortable protecting the downside for the economy. And the last thing that we've learned over the summer is that earnings, at least everything that we've heard from right now, remains really robust and, most importantly, broadening out. So we take these three themes and we lay that into our outlook for the next 3 months or so, where we talk about broadening out, maybe to large cap value, keeping quality in the core of your portfolio, stepping out from cash, really important,
so
into
hard.
that intermediate part of the fixed income markets. Yes, hard, but so important.
At these heights, as we're at all-time highs, to buy into this market takes courage. And I wonder if the labor market concerns you. We got a Conference Board consumer confidence number yesterday that was a real disappointment, and they put out a labor differential, which is essentially jobs that are plentiful and easy to get. It dropped to 12.6%. It had been 16.4. Then they revised that down to 15.9. So, but it still dropped from the August number. That implies, according to Barry Knapp over at Ironsides, a 4.4% U3 unemployment number and an 8.2% U6 unemployment number. Underemployment. If we're starting to talk about that, then the labor market must be a concern.
As of right now, obviously surveys are important. It does represent a few people that are responding to those surveys. But if you look at a broader array of data around the labor market, what I'm paying particular focus on is really how many people are getting laid off. The unemployment rate, as we know, especially when labor supply is going up, may not be the best indicator. But are people getting laid off? And I think when we start seeing that climb up meaningfully, that's when it becomes a driver of shock for the economy. For now, I think the Fed has given us a little bit of protection with that 50 basis point rate cut, with more to come.
You want another 50 basis points in November?
I think that right now they're going to watch what the data does. I don't think we know enough to know that it's going to be another 50 basis points, but I do think that they are willing. They've shown us that they're willing to do whatever it takes if they think the data needs for that to be.
I think this employment question is so important, particularly when you consider that the consumer sector, consumer discretionary, has been the biggest gainer in the S&P 500 over the course of the last month. And by a margin, if you could take a look there, more than 7.4% higher. If the labor market starts to weaken, and it's not just Tesla, I took a look, guys, it's like Norwegian Cruise Lines and other big consumer stocks. If the labor market starts to weaken, does that trade unwind?
I think if the labor market starts meaningfully weakening, I think some of these sectors can certainly feel a bit of weakness. And I also think that one of the areas, and we've talked about this here, one of the areas that has done really well is small cap stocks. And they've sort of gotten this push behind them because of rates becoming lower, coming lower. I think that's the area that I would be most cautious of going into the next couple of months. You know, Matt, you point out that, look, markets are at all-time highs, 41st all-time high, etc. And seasonally, September and October has seen a little bit of volatility, especially on election years. I think it's okay for investors to think about strategies that protect their downside for those looking for that protection. I think overall, history tells us that in cutting cycles, when the economy is fine, and you know, we talk about this in our outlook as well.
There aren't very many cutting cycles when the economy is fine, right?
They
cut 'cause
happen,
the economy's in trouble.
Absolutely, but when they happen, and let's hope this is one, equity markets over a 12-month or even a 6-month period tend to do very well.
Right.
But that doesn't mean the next 6 weeks or the next 8 weeks will be a straight line up. So for those investors that are looking to sort of protect their downside, there are so many ways in which they can do that with minimum volatility strategies, with buffered strategies, or you know, just stay high up in quality. And the area of the market that we like the most is really focusing on clipping coupon in the bond markets and in that intermediate belly of the curve.
Interesting. Not in cash, but in the belly.
Exactly. So we've been talking about how stepping out of cash, as difficult as it may feel, especially when yields were at above 5%, but certainly isn't the case anymore. We've talked about how these pause periods are really ripe and fertile for investments into high quality equities and bond markets. Even though the rate cutting cycle has now begun and is going to continue in our view, that doesn't mean that you can't have positive gains from equities as well as from bond markets. So we're still getting opportunities to clip 5.5% coupon without taking a huge amount of duration or down in quality risk. And I think that is the opportunity here.
And, you know, at the end of the day, do you think that there's better opportunity here when it comes to equities or bonds? Because if you can kind of play it safe and go into the belly, then why take on risk at all-time highs?
So I think that certainly given what we're getting in the bond markets right now, so if you're allocated to something like BINC, which is the BlackRock Income Fund, you have heard of that, yes, I know.
Special.
Exactly, but you can clip sort of 5.5–6% in some of those funds if you're looking at something even like in, you know, just looking at IEI, which is just 3 to 7 year treasuries, again, getting 4%. So I think there are some ways in which you can bolster your portfolio. I do think the Fed brings that negative correlation back. The idea that they are there if the economy falters and they're not afraid to cut aggressively brings negative correlation back, but you don't need to take a lot of duration risk because you're not being paid to. So stay in the belly, clip your coupon, and I think that makes for a really robust portfolio.
Gargi, thank you for joining us here on set, and happy birthday to you. I hope you get to enjoy that tonight. You work so hard. Of course, that is Gargi Chowdhury, BlackRock Chief Investment and Portfolio Strategist for the Americas. Also want to take a look here quickly at Flutter, because you have Flutter Entertainment shares reaching a record high, soaring almost 9% this morning because it had announced a $5 billion buyback of its shares. It also boosted its U.S. outlook. This is, of course, NFL season. People are placing their bets. It's also a company that moved its primary share listing to the New York from London earlier this year, one of Katie's favorite themes. We will keep an eye on that as we go along. DraftKings up higher as well. Now coming up, Tyson Foods gets a new sell rating as Piper Sandler sees beef, chicken, and pork headwinds. Details next in Top Calls. This is Bloomberg.
Principles, our policies in support of the Palestinian people will never change. Our policy in having a two-state solution will never change, and nothing will compromise it. And as long as we are, having the capability to be helpful, we will do it. We did that between Afghanistan, between Taliban and the US. We did that between different parties in Lebanon, in Sudan, and others. And that's basically the core of our foreign policy. It's been built based on mediation, on trying to help in resolving conflicts between the party. There are countries or people might not like it, but we don't ask everyone to like it, just to understand it.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
All right, it's time now for top calls. Some of the analyst action in focus this morning. And first up, Piper Sandler is downgrading Tyson Foods to a sell rating, citing risk across all meat categories, including rising cattle costs, falling chicken prices, and potential pork pricing pressures. Next up, we have KeyBank upgrading DoorDash to a buy, saying that the delivery company is gaining ground in its, quote, core and emerging verticals. And finally, we have Barclays saying that HP Enterprise is now a buy. The firm is upgrading the IT company amid signs of a recovery in enterprise servers. The analyst also sees HP Enterprise continuing to grow its AI server revenues, Matt.
All right, let's turn to DJT now, shall we? Shares of Trump Media and Technology were near all-time lows this week, despite the end of a 6-month lockup period on Friday, or maybe because of the end of a 6-month lockup period on Friday. Trump holds 57% of the company's outstanding stock and opted not to sell. That's what he says. Let's discuss this with Bloomberg's Bailey Lipschultz. So, Bailey, what do we know about DJT?
We know the lockup was lifted at the market close on Thursday, and we know that legally Donald Trump would have to file within 2 business days if he were to sell shares. So you can say, because it's 9:45 on Wednesday, as far as we know legally, Donald Trump had not sold through 9:45 on Monday. When you look at the trading volume, though, 14 million shares traded on Thursday, call it 21 to 20 the 3 days between Friday, Monday, and Tuesday. So some heavier volume because we only saw about 8 million shares traded. But the other insiders, co-founders that are United Atlantic Ventures, as well as Patrick Orlando's ARC, they don't actually have to disclose. So they technically could have been a big part of that selling, and they account for about 15 million shares between the two of them.
Well, I think that's what's fascinating about this. If you look at last week, it declined every single day. We're looking at 2 days of gains, 10% or more in total, and about 11%. It's still down significantly this year.
Yes, down significantly this year, down about 30% this month. There was a lot of positioning around the lockup expiring and who would sell and how quickly would they would sell.
That's typical, right? It's not that the stock is down despite the end of a lockup. The stock is usually down because of the end of a lockup.
Well, especially when you have, call it 15 million shares, about 9% of the company being held by insiders or former insiders who have nothing to do with the fundamental business anymore. Normally when you see an IPO, call it Reddit, when they go public, a lot of the insiders, they benefit if the company still does better in the long term. If you're an executive, you want the company to perform. United Atlantic Ventures and ARK, they actually have nothing to do with the company, so they have no real incentive unless they believe in Trump media. But with the number of lawsuits between those founders and Donald Trump himself, you can kind of read the tea leaves and assume that they likely would have been quick to get the exits.
Bill, you said the word fundamentals, and that's exactly where I want to go, because even with the declines that we're seeing, DJT, it has a market cap of nearly $3 billion. This is theoretically a social media company. You take a look at Reddit's market cap, for example, $11 billion. They're not as far apart as you might expect when you think about the user base, for example.
Well, when you look at the users, so Truth Social is the key asset for Trump Media, or Trump Media. They've had just under 400,000 active users, have failed to top 1 million active users in the last year. So actually, when you kind of break out those numbers, it's kind of a tremendous drop-off. They have been seeing kind of those numbers stabilize, but when you compare it to an X or, to your point, Reddit, even though we don't know what X is technically worth, Reddit is worth about 5 times that of Trump Media. The user base actually is much smaller, though you can argue it's loyal. They did only have just under $1 million in second quarter revenue, though. So
Reddit tops 1 million active users?
I believe so.
I'm kidding.
Now you're putting me in. I was like,
I'm kidding.
Oh my gosh, Bailey, thank you so very much. Of course, that is Bloomberg's Bailey Lipschultz, who has been following this story, as well as many other of our big equity names all year. Now, coming up, Jefferies is looking to keep the momentum going this year in trading and investment banking when it reports after the bell. We're going to take a look next in our Wall Street Beat. This is Bloomberg.
Was going to keep Green World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
This is Bloomberg Open Interest. Let's take a look at the stock market right now, about 20 minutes into the trading day. You can see the S&P 500, it's still unchanged. I'm trying really hard to make this interesting. We were a little bit higher, now a little bit lower, and I don't know, now unchanged.
Levels.
Take a look. Levels matter. Levels matter. We're at very elevated heights. Important to keep that in mind. You take a look at big tech, a little bit more to talk about there. The NASDAQ 100 currently up about 0.1%. And then you take a look at small caps. There's some action. Small caps currently down about 0.4% on that Russell 2000, Shanali.
And it's time now, Katie, for the Wall Street Beat. Jefferies looking to show progress in its bid to gain market share in the investment banking world. The firm is set to report earnings after the bell today, and here to look at what's ahead is Bloomberg finance reporter Catherine Doherty. You know, we look at Jefferies because it's kind of a bellwether, right? It's kind of telling you the way trading is going to shape up. We already have hints from the likes of Goldman that things are going to be a little weaker than they were in a gangbusters year ago. What do we expect from Jefferies?
So the other
element that we're going to be looking at here is within investment banking, advisory and debt and equity underwriting. So beyond trading, those are some of the key factors that are going to make a difference when looking ahead to the other big banks that are going to be reporting in October. Jefferies will break out these elements, and we'll start to get a flavor for what investment banking is going to look like across Wall Street in the U.S. Now, the interesting part about Jefferies, too, is that they really made a big bet on their people. They were hiring during some downturns, during a hiring freeze at other peers across Wall Street. So they've said that because of that hiring that they did, they're able to then look to see momentum and pick up market share because of the talent that they've invested in.
What does it tell us? I didn't know it was a bellwether. So
well, it always scares me because it's like, oh, earnings season is somehow here again.
Right, but so what can you take from Jefferies and use when you're looking at the rest of the street?
So they always come out a week or two before the other big U.S. banks. And it really is, it's core investment banking. So as Shonali said, trading will be the first kind of key sector that we'll be looking at, and then advisory. And that will give a sense of where are deals? Are they picking back up compared to not just a year ago, but the previous quarter? Summer is typically a slower period, but we didn't have a very slow summer. So it remains to be seen whether that will come through in revenue, and if advisory in particular is kind of the inflection point here.
You know, I was just taking a look at the shares, and I didn't realize this. Didn't know Jefferies was a bellwether necessarily. Didn't know that shares are up nearly 57% year to date. I mean, you compare that to JP Morgan, which we look at all the time, only up about 26% only. I mean, all in all, this has been a pretty good year for Jefferies in particular.
They've been showing significant growth, and they're not just attributing that to the overall market activity, but to market share gains, meaning that they're able to actually pick up and maintain the momentum that they've displayed. So we'll see if that comes through in the third quarter, whether their activity is it attributed to just more activity overall, in which case that could be at any bank. But what they're saying is, no, we're actually picking up market share as well.
Fun fact, Jefferies also is very heavily weighted towards private equity deals. And so as that comes back, presumably they would be the ones to benefit from it in this lower interest rate.
Wow, you know what? I just put a comp screen together. Look at this, Shonali. So I put Jefferies against Goldman Sachs, JP Morgan, Morgan Stanley, Bank of America, Citi. They outperform all of them over the past 5 years, up 253%, total return 313. So they really are crushing it.
Yeah, there you have it.
All right. Catherine, thank you so much for joining us. Catherine Doherty there looking at the banks first, looking at Jefferies, giving us a preview of what to expect. Let's get the trading diary so you know what to expect for the rest of the week. More Fed speak ahead throughout the week, including Chair Powell's pre-recorded remarks to the 10th Annual Treasury Market Conference. We're going to be paying extra special close attention to that conference. Shonali has flagged it because we're going to hear from William Barr as well. We get new home sales at the top of the next hour. We'll bring those to you as soon as they cross the housing market. Incredibly important and, well, I mean, just fascinating to follow. U.S. jobless claims come out on Thursday, as well as durable goods and revised GDP. That'll be very interesting. We'll see what kind of growth we're looking at. And we round out the week with PCE, a look at the Fed's preferred inflation measure, as well as the University of Michigan's consumer sentiment on Friday. Extra special because of the disappointment from the Conference Board.
Absolutely. And then you think about what's going to be a catalyst for this kind of boring market. I would bet it's PCE.
All right, coming up in the next hour, JP Morgan's Sitara Sundar joins us on volatility, which, as Katie pointed out, you know, the VIX is at a real low place. We're sitting, obviously, at an all-time high in the S&P. We'll get her call for the index. And then the CEO of Rolls-Royce Motor Cars joins us to talk about the ultimate luxury vehicles and Rolls-Royce's new private office here in New York City. This is Bloomberg.
2015, I was not optimistic because nobody was working on the hard problems. The energy R&D budgets had gone down. The venture investing in climate had gone down. It was completely out of fashion. So I don't know what people were optimistic about then. The fact is, we built essentially from scratch, with lots of supporters, a really mind-blowing level of innovation against emissions. And in the last 9 years, that's gone better than I would have expected. So only now could you even, plausibly be optimistic about the path of emissions. And someone who said, hey, nobody's ever scaled things up like the speed that we knew to before, they're welcome to say, hey, I'll believe this when I see it. In the meantime, some people who care about this issue are really out, trying to think, do we need permitting reform? Do we find, what new ideas haven't we found yet? How do we fund people with those new ideas? How do we get the costs of these things down? How do we collaborate on a global basis? So we're still not at the point where it's guaranteed or even that it'll be easy, but at least there's a theory of change.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Wednesday, everybody. I'm Alex Steele. Paul Sweeney still in Ireland. Jess Metton sitting in for him. This is Bloomberg Intelligence Radio. We cover all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. And we have a great lineup for you over the next hour. Damian Sassower will be joining us from Bloomberg Intelligence on the latest stimulus measures out of China. Plus, Matt Palazzoa will be joining us, Bloomberg Intelligence Senior Analyst for PNC Insurance. Plus, we'll talk to Daniel McGunn, AMSC CEO, on renewables and energy. Lots going on within the next hour. And Jess, of course, sitting next to me. Hello.
Yes.
Thank you
it's
for doing
so
triple
much
duty.
fun on this Wednesday. Always a pleasure filling in for Paul Sweeney.
Yeah, I just wish something was actually happening, but that's okay.
Though, I mean, the S&P 500 had 40 records through yesterday. Could have a 41st today.
It's
to put
true.
into context, though, the all-time high of whenever we saw the most closing records was actually 95. That was around 77. So we'll have to see where we close out the year with how many record closes.
If we get to 41, you know, okay, it's something. It just doesn't, we're up like 1/10 of 1%. All right, let's get it all kicked off for you. John Tucker is here with a Bloomberg Business Flash. John.
And the Market Drivers Report being brought to you by Interactive Brokers. Trade over 10,000 stocks and ETFs, U.S. equity index options, U.S. treasuries, and more on your timetable. Learn more at ibkr.com/round the clock. We are data dependent, so let's start off with the data. New home sales coming in at a 716,000 annual pace. That is better than expectations, a little lower than the previous month, though. And mortgages may have something to do with that. Mortgage refinancing rising to a 2-year high as homeowners capitalized on falling interest rates. 41st I thought yesterday was the 41st record for the S&P 500.
40th.
40th?
Yes.
All right. I'm wrong.
It was 40. Wait, hold on. I have in my notes.
You can look. Okay. After the record close for the S&P 500, whether it was the 40th or 41st, stocks this morning, they are a little changed. Shares of NVIDIA, they did some of the heavy lifting yesterday. Today, those are among the most actively traded shares. Shares of NVIDIA up another 2.25%. Sarah Hunt, chief market strategist at Alpine Saxon Woods, thinks, you know what, it's time for investors to start to broaden out their portfolios.
If you look at the market at a 22 multiple, you really need, for next, I mean, you really need things to continue to do well. You need those earnings to grow. So it's easier at this point to start looking in some of the smaller companies and trying to find ones where you see some growth because you're less worried about the balance sheet aspect than you were. You still need a good balance sheet, but with rates coming down, it's less of an issue.
And Adobe seeing online sales in the U.S. growing this holiday season, forecasting sales to hit $240.8 billion. Shares of Adobe, right now they're actually lower, down about 0.9%. In the yield space, the 2-year yield is up 3 basis points, 354. The 10-year right now is up just about 4 basis points. That is at 376. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Jess and Alex.
All right, John Tucker. Thank you so much, Alex.
Did you check?
Huh?
Did you check?
I think it's 41, but I don't want to mess with Jess.
What was 40 through yesterday's close?
40 yesterday?
Yeah.
Okay.
I have 4. Okay. So, I mean, I'm not going to mess with
Today
Jess.
would be 41, though, if we can hang on to these slight gains here.
I'm going to also check with Dan Curtis over in London, but, you know, far be it for me to mess with Jess. Mess with Jess should definitely be your own show, don't we think? Don't mess with Jess.
Branding. We should definitely.
Oh my God! Hashtag. We're doing it.
All right.
Okay, let's get some market drivers here. Want to dig deeper into some of those stocks on the move. Alexander Semenova, Bloomberg Equities reporter, joins us now. All right, Alex, what are you looking at?
Hey guys, always great to be on with you. I'm taking a look right now at General Motors. It's down more than 5%. At some point, was down more than 6%, having its worst day since 2022. This is after Morgan Stanley analyst Adam Jonas cut the car maker to underweight from equal weight. And also, he broadly downgraded his outlook for autos from attractive to inline. He said that at a high level, our downgrade is driven by a combination of international, domestic, and strategic factors that we believe may not be fully appreciated by investors. He also downgraded Ford, Rivian, and some other companies while upgrading several auto dealers, including AutoNation.
Nice. You know, something I was watching too is Tesla stock, because when you're looking at what's happening with some of these other EV makers as well, it's only up about 0.3%. But I was noticing that Morgan Stanley actually did downgrade GM and Ford earlier today, citing some of that China competition, as well as problems with the U.S. consumer. But RBC Capital and some other sell-side analysts were kind of upping their targets for Tesla because they're expecting those third quarter delivery numbers to come in stronger than expected. But what other corners of the equity market are you keeping a close eye on, Alex?
Yeah, also taking a look at Stitch Fix today. That stock is down pretty bad today. The move, nearly 35%. This is a personal styling platform. They issued a weaker than expected forecast.
It's the one that send stuff to your house, right? So like JT
Yes,
goes on
indeed.
the site and he's like, I want to dress like this, and they
Kind
send
of a
clothes.
subscription.
Now, I tried that not with
That's
this thing, but with the send the stuff to your house and you try it on with the glasses. Now the glasses don't fit.
Warby Parker.
3 times they got the lenses wrong.
I didn't even
This is a little
realize that they
different.
have
This is
that
a little
option for
different because
glasses, too.
it's not about lenses, but you know your point is taken. You're still wearing them though. You keep
I
complaining.
know,
about
because I'm cheap.
No.
I don't want to buy a new
They
pair.
look great, though.
Yeah, they look
sharp.
Yeah, they do look really good.
This is why I love Jess.
Don't mess with Jess. All right, sorry, Alex, I interrupted you. Go ahead.
Yeah, no. So Stitch Fix having a really bad day. Basically, analysts were disappointed by the company's projection that it'll only return to revenue growth by the end of fiscal 2026. So a long time here before they see growth again for that company.
You know, another thing that's moving today is travel stocks. So I think Expedia in particular is another one Alex is watching.
Yeah, yet another name that is down today that I'm mentioning right now. Shares down about 1.8% right now. This is after a downgrade from TD Cowen to hold from buy. They said that its consumer business may take longer than expected to turn around, and they also cited competition from Booking.com and Airbnb. So that stock not having a great day either.
Well, you watch the sell side targets very closely, and I know Goldman Sachs, David Costin over there yesterday, he's thinking that the S&P 500 can close at 6,000 now by year end.
Yeah, indeed. He issued that 12-month target it yesterday on Bloomberg Television, although if you think about it, we're only about 5% from that level. There are a lot of strategists who have gotten even more bullish, especially after the summer doldrums, notably BMO Capital Markets chief strategist Brian Belsky. He just upgraded his target to the highest on the street, 6,100 by the end of the year. And you know what's really interesting is Ed Yardeni at the end of last year was the first person to mention the 6,000 level on the S&P, and he said that would happen by 2025. And here you are, we have a ton of strategists now mentioning that target as something that could happen really soon.
Yeah. Right. Alex, great stuff. Really appreciate it. Alex Semenova joining us, Bloomberg equity reporter joining us there. But you know, that Adam Jonas call is having a definite move lower for those auto stocks. I thought that was pretty, I mean, he's one of the most influential auto analysts on the street.
It's true, but that's why I thought it was important just getting that call from Morgan Stanley and seeing what they're seeing when it comes to GM and Ford, and then the contrast there. But even Tesla, even though you're seeing it up just marginally right there, when you compare that to the other magnificent 7 stocks this year, Tesla's only up roughly around 2%, so far underperforming the other 6 big tech companies.
Yep, exactly. All right, the other sort of broader macro event within the market that had a different kind of move than what we saw yesterday was more stimulus from China. The PBOC cutting its 1-year interest rate by about 30 basis points. I was also reading that's going to give one-off cash handouts to people in extreme poverty. So there is a little bit of direct aid coming from the government as well. Joining us now for more, Damian Sassower, Bloomberg Intelligence Chief EM Fixed Income Strategist, who clearly couldn't stay away from radio. So he's
couldn't stay away from you, Alex.
There's that. Okay, Damian, so can you just walk us through the logistics of what the PBOC and the government announced today?
Yeah, sure. Well, I mean, it was announced yesterday. I mean, they have a 5-pronged stimulus package. They cut the RRR rate by 50 bips to 9.5%. They cut the 7-day repo rate by 20 bips to 1.5%. That's like their overnight rate. And then they cut the 1-year medium-term lending facility by 30 bips. That's the largest cut since 2016, really since the inception of that particular key rate. So those are the 3 big monetary stimulus kind of injections. You also have a swap facility that's being created for fund managers and insurers to borrow against their equity positions. And finally, a macro stabilization fund, which will allow the government to go in and actually buy equities directly in the secondary market. So this is all quite unusual. It's all happening all at once. Obviously, it's monetary, not fiscal. The fiscal stimulus side is what everybody's waiting for. And unfortunately, that remains sort of in stasis. I mean, it's behind budgeted plans because, quite frankly, project viability is weak, and there's been delays in fundraising, and quite frankly, risk of leverage. So a lot of government institutions are afraid to lend money in the current environment.
I'm glad you brought some of that up too, because when you're talking about the monetary side and the fiscal side, a couple months ago, Beijing also introduced this big package, I'm sure that you remember as well, as far as kind of injecting this shot that included rate cuts, more cash for banks, bigger incentives to buy homes, and of course, because it's struggling retail real estate market, but then also the plans to consider a stock stabilization fund. So right now, when we're seeing these types of moves from the PBOC, is this enough, or do you expect we will end up seeing more moves from here on the monetary side?
Well, I think we have to take a step back and look at performance over the better part of the last 5 years, Jess. I mean, look, big plans, okay, everything's big in China. China's a big place, but the fact of the matter is it's not having a big impact. I mean, if you just look at the performance of Chinese equities, you're down something like 12 to 10% over the better part of the last 5 years. If you look at China credit, dollar-denominated Chinese corporate credit is down something like 34% over the last 5 years. So the wealth destruction is real. You take that, you combine it with elevated levels of unemployment, specifically those for the younger generations, the millennials. You know, this whole Tengping movement, the lying flat movement is real, Jess. You know, they reject marriage, children, home ownership. They reject, you know, just the desire to overachieve in China. This kind of sentiment is difficult once you're conditioned with it to sort of overcome. And so people aren't spending. They're certainly not spending on big ticket items. And elevated youth unemployment, 16 to 24 years old in China, 19% last month. Wow. 19%. That's a big number.
And doesn't this all kind of boil down to, maybe this is too simplistic, that they spent a boatload of money on some stuff that didn't work out, and now they're stuck with excess leverage?
Like the One Belt and One Road initiative. I mean, look, you know, China is notable for, you know, investing abroad in places like, you know, Central Asia and Sub-Saharan Africa. And yes, a lot of those investments, a lot of those ports that you might find in places like Sri Lanka have saddled these economies with, you know, huge deficits. And, you know, there's been no return on investment to speak of, right? So to your point, you're absolutely right. China's a little bit wounded by the amount of money they've thrown into these, you know, investments that haven't had a return. But right now, the amount of unfinished homes in China that people have already paid for that need to be completed so that you could just get through to the next level here. I mean, that's really where the holdup is. And, the real estate market, despite the fact, actually, this is an interesting statistic, China high yield credit, which is dominated by the property issues, that's up something on the order of 12% year to date. So a lot of these bonds are coming back. Whether or not, that means that, there's going to be some workouts and that these companies are going to avoid default remains to be seen. But, we just haven't really seen the proof in the pudding yet.
Something else I was thinking about, Damien, was when it comes to the dollar and whether or not the PBOC is taking advantage of that recent weakness. If you look at the GP function for the max drawdown, the Bloomberg Dollar Spot Index down about 4% from that high that we saw in June. Yeah. So you think this is part of that play that they're trying to take advantage of it? It's
not profitable, actually, to use the synthetic market, to use swap markets, really bet against the China yuan because, from a mark-to-market basis, it's a negative carry trade pretty much. But there are profitable ways to do it. You could look at currencies in countries that are most linked to China, and those are the commodity producers, like, for example, South Africa and Chile. You look at their currencies, they're the biggest gainers week to date, right? If you look at Thailand or Malaysia, some of the sort of Asian economies that are most tightly linked to that of China, again, the best performers, week to date. So, if you just kind of take it and you extend that to the group of 10 currencies, who are the two countries who are most linked to China? Australia and New Zealand, just because of their regional proximity, the best performing currencies year to date. So there are better ways to play, I think, an appreciation of the China yuan without necessarily having to, take it, kind of get into that market, which is, capital constrained, I guess.
Yeah, and on the other side, it's interesting on the equity side. Like, I know your EM fixed income, but like, where do you do that? Because typically you do it in the DAX, right? But
Baba.
Germany, what'd you say?
Alibaba.
Alibaba. No, fair enough. But like, Germany has so many underlying issues on manufacturing and business confidence that's tricky. Like, even we're not seeing the kind of pop that we're used to. And I wonder, usually then, okay, let's go to luxury guys. Let's go to LVMH. Let's go to the CAC 40. But is, one-off cash handouts to people in extreme poverty really going to lift LVMH? No.
Well, I mean, you make a great point here. And, usually there are two crosses really which really drive the dollar. That's the euro dollar and that's dollar yuan, right? It's really kind of moved toward dollar yen now. But you make a really good point. I have to rerun these numbers, Alex, because, the euro really should be outperforming the dollar if China's indeed, showing signs of improvement on the growth side, right? I mean, you should definitely see that. And again, this might open the door for greater runway for dollar weakness. And I think that's a great point. I mean, I haven't seen really what the euro is doing week to date. I have to imagine it's up because it's a cyclical growth type of currency relative to the dollar. So yeah, I mean, I think that's another smart way of playing it, looking at, Germany and some of these European industrials.
And you brought up the yuan. I know that it rallied past that $7 per dollar milestone. Is there a particular level that you like to keep a close eye on as far as how it's trading?
Just meant in the psychological 7 handle. JT, do you hear what's going on here with Jeff? She's talking about the psychological 7 handle.
This is right up your alley.
Now, here's the thing. It was the offshore yuan, which actually briefly broke below 7 overnight. It's now back to 701. The onshore is just about a point, higher than that. So, look, that is a pretty big level. I mean, it certainly may give some confidence if it can break below there and hold there. But, this has been a very quick move from 725 down to where we are now 7. I mean, at some point, if you were, riding that move or at least half of it, you would want to be being prudent here and maybe taking a bit of profits. But that's just me.
What do you think we're going to hear from China tonight? Like, it's going to be like a drip thing, like every day?
No,
what do you think?
I think, quite frankly, I think PBOC Governor Peng Gaucheng had to basically basically got some really weak data, said we're not going to hit 5%, told Xi Jinping this, and they said, well, turn up the spigot, right? I mean, this is kind of the same thing they did with COVID and the pandemic. I mean, this is sort of their reaction function right now. It's like, look, for me, I don't think we're going to hear all that much more. They tend to be very opaque, but we have to look at the data that's coming through. And the next big data print is on the 29th of September. We get PMI. The PMI is in slight expansion in China right now. I think it's 50.1, but, manufacturing's in contraction. We need to see some improvement on that front. And then, as we get into the middle of October, we get inflation, trade, and GDP. And I think those are going to be the big data points the market's going to be focused on.
You brought up the medium-term lending facility, or the MLF. So I know the PBOC had been recently downplaying some of those types of corners there of what it was doing as far as the monetary and the fiscal side of things. But how much of that, when it comes to like liquidity concerns for banks, when you're eyeing that, is that a concern? Is it not a concern?
That is such a Stephen Chu question. Hence my chief Asia rates and FX guy. When it comes to the actual, the actual mechanisms at the disposal of the PBOC and what they can actually fine tune and how that's going to flow through into the market, that's not really me. I mean, I look at the 1 year, it's really more a proxy for 1 year mortgage rates, right? I mean, that's really what we're talking about here. And I guess, for me, yeah, no, it's a step in the right direction. It's a big cut, but how many people are really, going to feel the impact of that overnight? My guess is not that many.
All right, Damien, thank you so much. Super appreciate you. Damien Sassower, Bloomberg Intelligence, EM fixed income analyst over at Bloomberg Intelligence. And just want to let our listeners know that starting in October 1st, the place to listen to us in the Bay Area is on Bloomberg Business app. It works seamlessly in your car with Apple CarPlay and Android Auto. Make that switch today because October 1st, Bloomberg Radio is streaming directly to your phone. The Bay Area's new home for Bloomberg Radio is the Bloomberg Business app. Download it for free at the Apple App Store or on Google Play. All right, coming up, we are going to be talking to Nancy Dowd, a private wealth manager over at Ameriprise Financial and CEO of Opus. We're going to discuss her outlook on the markets. Plus, Matt Palazzoa, Bloomberg Intelligence senior analyst for PNC Insurance, on some losses in some of the insurers and some of those big storms. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. The S&P 500 adding to its record close. You for the 11 major industry groups in the index. They are higher right now. Information technology, that is in the lead, and that is home to, come on everybody, say it, NVIDIA. Those shares, you missed it, 1% higher.
Sorry, was I supposed to? My bad. Go ahead.
I'm glad you're really paying attention to any of this. Today, the best performing stock of the index that belongs to Hewlett-Packard Enterprise. It is up over 5.5% right now, benefiting from an upgrade by an analyst at Barclays. At least 4 analysts boosting their estimates for Tesla's third quarter delivery numbers, which are due next week. Tesla possibly looking at its best quarter ever in China. Somebody's going to have to explain that to me after Damien was just here telling us about the slowdown in China. Right now, Tesla down just about 0.5%. And among the data this week, we get the PCE deflator, the University of Michigan consumer sentiment. That's all out on Friday. S&P 500 right now, 3 points higher at 5736. The Dow Jones Industrial Average, 153 points lower. That is down 0.4%. 42,054 in the index. The NASDAQ 100, that is higher, up 87 points. That's a rise of 0.4%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Jess and Alex.
All right, thanks so much, John Tucker. To be fair, I am paying attention. It just wasn't to you at that moment.
We were
I was
focusing
reading.
on some other stats.
I'm not offended. I'm used to being totally ignored by you.
It's fair. I'm Alex Dio alongside John Tucker and just mentioned Paul Sweeney is off today. This is Bloomberg Intelligence Radio, and we are broadcasting to you live from Interactive Broker Studio right here in Midtown Manhattan, where gridlock reigns. Want to get a take on the market here. Nothing's going on, so it's a good time to kind of recalibrate. What do you do as yields kind of come down? The back end, though, still stays a little bit higher. How do you position yourself for that when tech also is still outperforming? Nancy Dowd, a private wealth advisor at Ameriprise Financial and CEO of Opus, joins us now to discuss her take on the markets. Nancy, we've sort of gotten through this seminal moment with the Fed. How do you need to rethink what your portfolio looks like?
So it was a big surprise. We all bet on a 1/4 point cut, but I guess the Fed decided to front load the rate cuts. Although overall, the plan is still the same: is to get to a certain target, or by 3% by mid-year 2026. So it was a bit of an enigma as to why they front loaded this rate cut. But in digging deeper in the details, the justification really had to do largely with the inflation numbers not being quite where they really want them to be, at least 2 out of the 3 that they watch. And also the employment numbers are weakening, and that gave a little bit of concern to the Fed. So they just cut more aggressively. So now this is what we're dealing with, and I think the biggest impact was mortgage applications. I think that's probably the biggest impact in the last 2 weeks.
So what do you think the playbook is as far as what you're advising clients to buy, what you're advising them to sell? Because traditionally, I mean, every rate cutting cycle can be very different, but normally you would see, say, for instance, bond proxy like sectors like utilities outperform and tech underperform the first 6 months after a rate cut. But you've already had sectors like utilities taking off. A lot of that's tied to the AI story, and that sector's the second best performer in the S&P 500 so far this year. So where do you put your money?
Well, if you're fully invested, clearly stay the course. But I think that the reaction over the last 6 weeks and certainly over the last 2 weeks is way overdone in the stock market. And I would err on the side of caution that I think we are probably due for a pullback or even a correction or more. It wouldn't be so unreasonable at this time because this is just overdone.
So would you use that then to add to use that as a buying opportunity?
Well, yeah, absolutely. That's the best time because longer term prospects obviously are very good. So if there is this correction or pullback, it's a grand opportunity to buy in or rebalance, reconsolidate how you're allocated according to your time frame and your risk tolerance. But certainly the sectors that you mentioned are very attractive. Defensive stocks will be a good play right now, such as materials, industrials, utilities. The big enigma really is energy. You know, I still look into energy, but the big enigma has been why, with all the geopolitical risk that we are experiencing, and more so in the last week or so, why energy is down. That's a big enigma, but I would still buy it.
When you take a look at, say, if you don't get the drawdown, one part of that story is like, hey, there's over $6 trillion sitting in money market funds. That belongs somewhere. Does it go into the equity market? Does it go into the bond market? Do you think that that is part of this story that we're going to see?
Well, clearly, broader diversification is highly indicated at this time. When you're too concentrated in one sector, you feel the volatility, and the pullback will be felt significantly more. Especially in the technology sector, because that tends to be significantly more volatile. But diversification is very good right now, especially in the fixed income side, still maintaining shorter durations because it's still very iffy with the rate cuts. I do believe that the geopolitical risk is just being ignored and is not factored into the markets. And when that does happen, it could be significant.
I know that you've previously used a 4% inflation assumption in your financial plans the past few decades. I'm sure just given where the dynamic with inflation was prior to COVID, maybe your clients didn't appreciate it as fully until recent years. But with inflation having closer to that 2% target, how does that impact how you construct your portfolio models? Is that something that you'll still include, or are you going to adjust that now?
No, I will not be adjusting it, because by using a more conservative inflation rate, it has really helped my clients achieve their outcomes much better. Because remember, you know, the overall inflation rate is not the same as the day-to-day inflation rate. I'm talking about food, gas, electricity, and heat, these are the non-negotiables of everyday living. You may give up going out to eat, to travel, or discretionary spending, but you're never going to give up food, gas, and electricity. So these are the things that matter the most. And in fact, those are the things that go up the most over the last 3 to 4 decades that I've been advising clients.
All right. Thank you very much, Nancy. We really appreciate Nancy Dowd joining us, private wealth advisor at Ameriprise Financial and CEO of Opus on the Markets. All right. It is still hurricane/storm season. I know it feels like it's been longer and longer. I think there's one barreling towards Florida now as well. So we want to check in on what this means for the insurers with Matt Palazzoa. He is Bloomberg Intelligence Senior Industry Analyst for PNC Insurance. Hey, Matt, what is the state of storms right now?
State of storm. So we were expecting a really active hurricane season. It's been, I think, milder than we've expected. We're seeing activity. We're past the peak of the hurricane season. What we have now is I don't know if it's a hurricane yet, Hurricane Helene, heading towards the panhandle of Florida. Probably going to be a Category 3 at landfall. And the way we look at these things is we try to compare it to previous storms. There was one in 2018, Hurricane Michael, one in 2023, Hurricane Idalia. It looks like Helene might kind of split right in between and hit around Tallahassee.
So which insurers does this impact the most depending on different regions? I was looking at the S&P 500 insurers index. I mean, it's up around 28%, not moving this year alone, but today just kind of flat. So I'm kind of wondering which insurers are impacted more so.
Yeah, so Florida specifically has a lot of smaller companies that you probably aren't going to see in these names. You know, Allstate's a big one. Progressive has some business there. Typically, when you think of hurricanes, you might think of reinsurance companies. Paul's not here; those are his favorite companies. Right. But this probably is not going to be an event that would hit them. It's still uncertain. You know, it's probably not going to hit till tomorrow. So uncertain, but it probably won't reach reinsurance companies. Won't reach those large companies that you're probably seeing in the index.
But isn't also one of the problems that, at least in Florida, maybe even California, that you're not seeing traditional insurers insure stuff because of all the climate change and storms, meaning that you do have these small guys that have to take on more risk?
Yeah, so that happens, Alex. And what also happens in California, Florida specifically, is the state takes on a lot of these policies. So they kind of have these insurers of last resort that end up taking the business that the large nationals don't want to. In Florida, they've been moving they call them takeouts. They've been moving some of these policyholders onto smaller companies from the state funds, but the general movement of insurers has been away from these high-risk areas.
So what's the outlook for insurers as a whole for this year so far, and their outlooks moving forward for on the earnings side of things?
Yeah, so despite what we're talking about right now, it's been a pretty mild hurricane season, catastrophe season. It seems like the ROEs of insurers are going to do pretty well this year, above average, which I think is driving the performance that you're seeing. Fundamentals are still strong. Lower interest rates will be, I won't say a headwind, but less of a tailwind. But less so for insurance companies probably than other financials. So if you're in that space, they're probably a more attractive financial to be in.
What else are you looking at in this space? Like, how do these companies then wind up making money, and that what are they doing with the money they're getting from payments?
So you'd be surprised, especially in homeowners insurance, even without large losses, you know, sometimes the industry is losing money on the whole. The ROEs are good this year because there's been a dearth of large losses. They're not doing anything kind of dramatic. I think what we're seeing is the rise of a couple of things globally. One is political risk higher than it's ever been. So these kind of global names are seeing a lot more international risk. And you're also seeing cyber risk, which is something that they haven't seen in the past. So a new and emerging risk that they kind of have to deal with. So their capital positions are strong, but they're not doing anything crazy, not a lot of M&A to kind of spend that excess profit.
We only have about a minute left here, but once we get into the thick of things, when earnings season ramps up again in the middle of October, if you were on some of these analyst calls to ask some of these insurers questions, what would be some of your top questions for them?
Yeah, so another thing that we haven't talked about is liability reserves, right? So these companies write business and then they don't pay these claims for several years in the future. And what has been happening is these claims have been worse than expected, a lot worse.
Oh, interesting.
And it's been offset. Workers' compensation claims have actually been better than expected. So the workers' compensation is offsetting liability. The big concern is, when does that flip? And that could be a big earnings swing for these companies. You're seeing little bits of evidence of it kind of peak up, and I think that will be a big topic on the earnings calls.
As a homeowner, I had to go for, well, Allstate dropped me because I'm like within 50 miles of the ocean.
Oh, really?
I had to be picked up by Joe's Insurance of Bayonne or something like that.
And was it a lot more expensive than what you did?
Oh, a lot more, yeah.
Like, by how much percent?
Tripled. At least.
Wow.
Oh, yeah, at least. So.
Oh my gosh! Wow. Okay.
I mean, it's a concern if you're going to move to somewhere as a retiree.
That's
you know,
hard.
you got to take that into consideration.
Absolutely. All right, good stuff. Hey, Matt, appreciate it. Matt Palazoa joining us from Bloomberg Intelligence. All right, coming up, Daniel McGann is AMSC CEO. That is American Superconductor Corporation. It's an electrical power equipment company. We're going to talk about renewables, energy, maybe a little bit of AI, all mixed in together. This is Bloomberg Intelligence.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker at the Bloomberg Newsroom with this Bloomberg Business Flash. S&P 500, little change right now, 2 points after the benchmark hit its 41st record close this year, yesterday. NASDAQ 100 pushing higher, and that's getting a lift from NVIDIA shares. Shares of NVIDIA, they did a lot of the heavy lifting yesterday for those records. Right now, up another 3%. And the Treasury yields right now, the benchmark, the 10-year, right around 377, so that's up 4 basis points. Meantime, Dean Kernit at Macro Risk Advisors is advising investors to add gold to their portfolios.
It occupies a very important place in the portfolio right now. It's scarce. It's in demand by central banks. And it's got this, what I would just call anti-correlation aspect or characteristic to it, which is on the worst days for the S&P, gold hangs in there. That's a very important property to have in your portfolio right now.
And so traders seeking some fresh catalysts after the half-point cut last week, slowing hiring in the U.S. That's become a top concern among investors. The next data, a big data point on the calendar, is potentially, well, that's next week, the latest monthly update on the jobs market. That's going to arrive. Also, we got some data today, sales of new homes in the U.S. pulling back in August after a sharp increase in the prior month. By the way, want to guess what the median home sales price in the U.S. is?
$450,000.
Close. $420,600. Who can afford that?
I was really, can we just say that I was like kind of on that?
Well,
Isn't that
you're a
impressive?
genius.
I'm a millennial, so that means I don't have a house. I have an apartment.
It looks like you're never going to get one either.
Yeah,
anyway,
so that's pretty steep.
it's kind of a downer. We check the markets for
It's
you
okay.
all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Jess, Alex.
All right, thanks so much, John Tucker. Alex Steele here alongside Jess Menton and John Tucker. Paul Sweeney is off today. This is Bloomberg Intelligence Radio. We cover all the top news in business, economics, and finance. And right now in New York City, what's happening is you have the UN General Assembly and you have Climate Week. So the benefit is we get a lot of companies now coming in that are involved in the energy transition. Then we get to talk to them about the really cool stuff that they're doing. And one of them is a company called AMSC. Now, you just look at a chart of its market cap over the last 5 years. It went from about $200 million to now almost $1 billion. It's been a tremendous rise.
And that stock's up 116% year to date.
What does it do? I'm not really sure. It's called American Superconductor Corporation, and our CEO is here to break it all down for us. Dan McGann joining us. All right, Daniel, what do you guys do? Break it down.
We basically provide resiliency equipment for the grid today. We help bring more renewables onto the grid, and we have a nascent business that's starting to grow pretty rapidly, supporting ships in the fleet to protect them from harm's way.
So do you make the stuff that helps a solar farm plug into the grid? Are you
We're the big equipment that sits on the grid that allows that power to be able to come on and make sure it harmonizes with the grid in a way that the grid can accept it and take it.
There's been a shortage of this stuff, right? It's a huge backlog and shortage of the stuff that you make.
Yeah, we just had a record quarter where we delivered new orders about 127 million. Just to put it in context, we're about 146 for the entire year. We grew last quarter 30% versus the year ago period, and we just guided for 30% growth quarter on quarter. So we're kind of hitting it out of the park on all levels right now.
And you've also made some recent acquisitions. I read about how NWL, that's a private company based in New Jersey that provides power supplies in industrial and military customers, but then also you're getting into the wind turbine electrical control systems with some recent deals as well. So how much do you expect those types of deals to help bolster your revenue growth moving forward?
Yeah, we think that the backlog continues to grow. I think we went up from about 140 last quarter to about 160 for the 12-month backlog. Total backlog for all time is even higher than probably 200 or so. So we're in well positioned to kind of grow quarter on quarter here. That's what we just updated our guidance for the current quarter, which will end here in a week or so. And we think we're well positioned. I mean, the past year has been fantastic for us. We went from being really excited about reaching 30 million per quarter on a revenue basis to now we just got it to 50. So the business is really taking off. It's very healthy. And then the backlog is very deep along all product lines.
What's the biggest constraint that you have in delivering the key product that everyone needs to then connect to the grid?
I think if you'd asked me that question a couple years ago, I would say supply chain was part of it, just to be able to deal with the speed. Now it's really we're scaling production, we're hiring. So it's really typical type business challenges on how do you manage that growth and how do you remain effective for your customers as you grow.
And what are some of the top questions or concerns you're actually hearing from your customers at this point? And what do you think that tells us about the direction of the economy?
I think the good signs we've seen is we've seen lead times on our products drop. So our lead times at one point were approaching 18 months on some products, and now we have stuff today we're delivering in 4, 5, 6 months. So the demand is growing, and the demand for products sooner is growing as well, and that's really a competitive advantage for us in the market.
Do you have a better way to move electrons? I mean, the name implies, superconductors. So.
Right.
At the heart of what we do, particularly on the ship business, is about superconductors. So yeah, we move electricity in a much better way.
But you got to keep that really cold for a superconductor.
Super cold, yeah. We do that as well. So that's part of our scope and what we deliver.
Oh, that's very cool.
We do a fully integrated system for the U.S. Navy, and we just got a contract in excess of $75 million for the Royal Canadian Navy. So we're going to be on Canadian ships as well. And that's all superconductor.
So with better lead times, is that just due to the supply constraints with the chain? Just they're not as bad as they would have been because
they're not as bad. We've done more to be able to plan. What we're seeing is customers not buying a few, but buying many, which allows us to be able to better plan our production and be able to plan our supply. So part of our growth has been larger projects, larger orders, and multiple units of the same type, which has been great for us, for our business.
So let's broaden out for a second. We've had a couple of AI data centers and energy deals. Amazon went the way of here's my own little power center that I'm going to use and connect directly to it. Microsoft went more of the way, hey, we're going to buy contracts from Constellation Energy. Constellation Energy is going to re-up one of its nuclear facilities and connect that to the grid. How do you foresee these partnerships moving forward, and how does that affect you guys?
I think it affects us because the rising tide lifts all boats. There's a huge investment in making the grid more resilient. There's more demand, be it from data, be it from AI. We see a huge potential boom coming for us because we provide power control solutions for semiconductor fabs. There's a huge move in our country to reshore that capability. Each of the chip makers, I think, individually have announced at least $20 billion of capital investment in new fabs. And that's all going to benefit from us as well, because we're building the substation level equipment. These are big pieces of equipment. They're 10, 20, some cases 60 tons. They're like big mobile home type size.
What's your level of confidence it all gets built? Because even Intel had to pare back some of those plans.
Yeah, if they build a fraction of it, it's going to be a home run for us. So I know, when people talked about, we have a play in electric vehicles and hybrid vehicles because we supply the power control equipment for the people that make the feedstocks that go into those. I think that if we're even able to get to a fraction of what people hope and desire, I think it's a big deal for our business.
So what's next? Any other potential acquisitions you want to maybe tell us about?
We have a lot of people that approach us. We've done, over a few year period here, we've done a number of acquisitions. They've all worked really, really well. We focus on good people with a good product. So we find that there's a lot of inbound traffic our way saying, would this be a good fit for where we are? We think we can continue to grow organically and inorganically the business. We have a wonderful platform globally to be able to sell. We have a great brand in the market, and we want to continue to leverage that. And really, at the end of the day, we want to serve what our customers need and try to be there ahead of them before they really need it.
All right, Daniel, we really appreciate it. Thank you so much for stopping by. Daniel McGann, AMSC CEO, joining us. American Superconductor. It's a great name.
It is. I was looking at the A and R function in the terminal. There's 3 buys, 0 holds, 0 sells right now.
I mean, when you have the broader thesis, it's hard to kind of find the holes there. Yeah,
right.
At the end of the day. I think it just depends also on where we go, say, with the presidential election. That's obviously a conversation that percolates right now during Climate Week. If we get a different administration, like a Trump administration, does all of this wind up changing?
Right.
I mean, many are going to say no, because the jobs are already in Republican states, for example. There's a great piece out from Jennifer Dooley that sort of looks at that and shows that a lot of the jobs added from clean energy are in Republican states.
Yeah, it's really fascinating to see kind of where this is headed. But what a run for this stock, over 100% gain year to date.
Yeah. All right, coming up, we are going to talk about Visa and the latest antitrust litigation. Justin Teresi will be joining us, Bloomberg Intelligence antitrust litigation and policy analyst, on the latest with the DOJ and this investigation. We'll get that to you. That stock has been hit over the last few days on reports. This is Bloomberg Intelligence.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Wednesday, everybody. I'm Alex Steele here alongside Jess Menton and John Tucker. Paul Sweeney is off today. This is Bloomberg Intelligence Radio. We cover all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks, because they cover 2,000 companies and 130 industries worldwide. One stock we're watching today is Visa. It's down 1%, but over the last couple days, it's been hit pretty hard as the DOJ has now sued the company over an antitrust matter. And this is according to a filing in federal court in Manhattan. Attorney General Merrick Garland held a press conference yesterday discussing the lawsuit, saying that Visa illegally maintains a monopoly over debit network markets.
We allege that to maintain this monopoly power, Visa deploys a web of unlawful anti-competitive agreements to penalize merchants and banks for using competing payment networks. At the same time, it coerces would-be market entrants into unlawful agreements not to compete.
Joining us now for more is Justin Teresi, Bloomberg Intelligence antitrust litigation and policy analyst. Hey, Justin, what did you make of this filing? Did it surprise you? Do you think the DOJ has legs here?
Yeah, hey, Alex, thanks so much for having me today. So the filing itself wasn't too surprising. We know that DOJ opened an investigation back in 2021 related to Visa and its debit card practices. So we thought something might be coming. The timing before the election makes sense. We'd see it now rather than later on this year. The complaint itself, it seems fairly strong. As the Attorney General said yesterday in his press conference, Basically, they're alleging that after Dodd-Frank and rules came into place about being able to route debit transactions over more than one network, Visa entered a series of contracts with merchants and banks that allowed it to favor its own network over those of its competitors. Seems like some true antitrust activity here that DOJ is alleging.
And Alex was just talking about the stock drop that we've seen in recent sessions after the peak that we saw it trading at earlier this month around as September 17th. I mean, it had a max drawdown of around 8% since then. When you're thinking about, and especially when you're talking about the current administration and the election coming up, do you think a new administration would be able to potentially amend a settlement here?
Yeah, there's a couple of things to consider here. The first being is that this is not Visa's first time at the antitrust rodeo, if you will. The company was sued back in 2001 when it was still linked together with MasterCard before it went public. And that case ended in a settlement. In 2010, there was a similar antitrust suit related to credit card fees. That case also ended in a settlement. So there is some history here of these cases tending to settle, and whether or not a new administration might be amenable to that, it really remains to be seen. But I think settlement is certainly something that's on the table. And important to remember in all of this, too, is that the DOJ is really after some behavioral changes with regard to these agreements, right? We're not talking about some kind of a structural change in Visa as a result of this litigation, most likely.
Right. So then what does that look like? So they can't pay Apple anymore, et cetera. So Apple loses money. And then what does Visa do?
Yeah, it's a really a great question. And I think one that really goes to the heart of Visa's debit business here. DOJ is alleging that as a result of 180 of the largest of these contracts that Visa has, they've been able to shield themselves from competition on 75% of the debit volume that's going through its network. So this is a big money maker for Visa. It's something to really keep our eye on here because it could result in a chunk of its business going away if these contracts were to also go away. So that's really, I think, what we have to scratch our heads about and wonder, is that the ultimate remedy that we see from DOJ? But lots of time, too. I'll give you an example. The Google search case from filing to trial, that was a 3-year time span before we got there. So this is going to be something that's around for quite a while.
Is there any way that Visa could argue that the complaint fails to account for increasing competition from alternative payment methods if you're thinking about account-to-account transfers?
Yeah, and I think that's exactly where we could see Visa go in its motion to dismiss arguments or later on down the line. You're right. We're seeing this increase in competition from things like Venmo or Cash App, right? But the complaint is basically alleging that those forums haven't been able to scale up to be as large as they really could be because of deals they have with Visa. But the reality is, as you and I both know, folks are using those platforms, and the marketplace is changing. So I think that's probably going to be part of parcel to what we see Visa saying in its defense here.
How long does something like this take, particularly as Jess was pointing out, we might have a change in administration?
Yeah. Again, really slow-moving cases here. I think this is going to be something that's around, I would say, for the next 2 or 3 years. At a minimum, we're going to go through a ton of motion to dismiss practice next year, likely get over that and find ourselves in a discovery phase. So
is this like an overhang on the stock then until then?
I would say so. I mean, how the stock reacts is how the stock reacts, but the overhang is something that is a long-term risk. I would say that's absolutely accurate.
In what ways do you think it would impact Visa's earnings and revenue outlook?
Again, I think we really have to go to the heart of the question here with, the actual percentage of debit transactions that Visa's been able to shield itself from competition on. Again, the complaint, if it's correct, and again, the government's best day is always the day they file their complaint because no one's really, responded to it yet. But if the government's correct that Visa shielded itself from competition on 75% of its transactions from these largest contracts, that's a significant part of Visa's actual debit revenue. So that, I think, is where the concern is coming in. It really goes to the heart of Visa's debit business. Yeah. And we'll have to see what plays out over the next couple of years here with regard to possible remedies or a settlement.
Hey, Justin, we really appreciate it. Justin Teresi, Bloomberg Intelligence, antitrust litigation and policy analyst. Have you guys also noticed, too, like you go into stores and it's like extra 5% if you use a credit card versus cash? Like all of
definitely.
That stuff.
Restaurants, too. I've seen this recently as well.
Yeah, to the point where it's like, wow, 5% is something.
Right.
Well, no, the small merchants won't even let me use a card if it's less than $20.
Yeah, that happens.
And that's wrong. That's not good Visa will cancel them if they do that. But
Right.
they still do it.
That's the point, because they have to then pass on the costs. All right, we have a lot more coming up within the next hour of Bloomberg Intelligence. Stuart Paul will be joining us, U.S. economist with Bloomberg Economics, on mortgage rates. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Wednesday, everybody. I'm Alex Steele alongside Jess Ment and Paul Sweeney off today, and John Tucker is here in studio. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of Bloomberg Intelligence, folks. We have a great lineup for you over the next hour. Stuart Paul will be joining us from Bloomberg Economics to discuss those new home sales and mortgage rates. Bobby Ghosh, the senior news editor for Bloomberg, also will be discussing the latest with Israel and Hezbollah. Plus, Michael Cugino, president and portfolio manager at the Permanent Portfolio Family of Funds, will discuss his take on the markets. And Philip Richards, Bloomberg Intelligence senior analyst for European banks, will talk to us on commerce and UniCredit and the latest drama that is unfolding there. So let's kick this all off for you now for the next hour with John Tucker for the Business Flash.
All right, guys, this week has seen the S&P 500 notch its 40th and 41st new all-time highs of the year. I don't mean to correct you. Anyway, today, trying to grind its way to a 42nd
Don't mess with Jess, except when she's sick for one day.
I was sick yesterday. Well, I
lost count too.
Yeah.
The leaders in the index right now include Hewlett-Packard Enterprise, Intel, Vistra, and yes, NVIDIA. Global Payments, that's right now the biggest drag in the index. Two analysts backing off their bullish rating following the company's investor conference. William Blair describes the company's situation as being, in his words, or in their words, stuck in the mud. It's down right now over 6%. In the meantime, Andrew Sheets at Morgan Stanley sees a pretty positive backdrop for stocks overall.
We are believers in the soft landing case. We do think that the data in the U.S. is holding up okay. We do think the Fed will now continue to cut at kind of 25 basis point increments.
Right now, the S&P 500 up just about a point, 57.33 on the index. Dow Jones Industrial Average down 146 points, 42,063 on the index. The NASDAQ 154 points higher. That is up 0.3%. Two-year yield up 3 basis points. That's at 354. The 10-year 4 basis points higher. That is at 376. And the Mortgage Bankers Association, their refinancing index jumping in the week ended September 20th to the highest level since April 2022. More people refining. The rate on the 30-year fixed mortgage, by the way, easing 2 basis points right now, right around 6.13%, the 8th straight weekly drop. And no, I'm not going to ask you what your rate is, Alex.
Sure.
Everybody
Are you
feel
sure?
bad?
I think you want to. Does Jess know what my rate is?
I know what Paul Sweeney's is because he likes to tell us about that. He's right. Yeah.
Okay. Well, Jess doesn't know, so I have to say it now because otherwise it's just awkward. My 30-year fixed mortgage rate is 2.75%.
Wow. So you were able to lock that in
did.
ahead of what happened in
We
recent
locked it
years.
in November of 2020.
Oh, there we
And
go.
she's
Prime
so
time.
proud
I
of
mean,
herself.
come on.
I think
You would
Sweeney
think
was a
you
couple years
had
ago,
it.
so he was in the height of when things are really
So he's still
elevated.
waiting. He said he wants
He's
a 4
refinancing
handle
soon. Oh,
before
yeah,
he
he's
refis.
trying,
I was
yeah.
interested that the refi happening with a 6 handle, low sixes, is quite interesting.
Yeah.
Anyway, I digress. John Tucker has nothing more he wants to say to me about my mortgage rate. All right, let's get some more details on the markets here. Abigail Doolittle, Bloomberg News chief markets correspondent, is joining us now. Abigail, what is on your radar today?
Well, this S&P 500 barely doing anything on the surface, but lots of movers beneath the surface. One of the best stocks for the S&P 500. In fact, it is the best stock from a percentage standpoint. HP Enterprise, Barclays upgrading shares, saying that this company could really benefit from an overall enterprise server rebound. But in addition, because they really don't have any quote-unquote AI premium priced in, they could benefit that much more, plus accretion from the closure of the deal with Juniper. So some good things happening there. there. Intel up 4.6%. It seems as though there's some speculation about whether or not they'll work with Apollo. Apollo, not so long ago, extending the possibility of up to $5 billion in funding to help out the beleaguered chip maker really fund the turnaround. Then there's also the friendly takeover talk from Qualcomm. To the downside, GM, Ford, these automakers really getting hit by Adam Jonas and Axe in the car space, the automakers downgrading GM to an underperform from, I think, basically either the equivalent of a buy or neutral, Ford to the equivalent of a neutral, but saying that these companies really lots of headwinds out there, including an uncertain consumer and credit situation.